It seems to me that we're in a deflationary situation for sure for two reasons. Number one is the velocity of money. If you bring up a chart of money supply, it's at an all-time high. If you bring up a chart of velocity of money, it's lower than it's been in the history. The chart I've seen goes back to 1960.
You recommend physical gold.
If your goal is cash flow, it is a bad idea.
Right.
If your goal is insurance, it's the best idea to have physical. There are a lot of things that swirl around paper gold and derivatives of gold, such as ETFs. And the gold bugs that's just, we don't want to talk about those at all. Those are horrible. They're not legitimate. Well, no, they're legitimate for different reasons. If I want to trade, I'm trading that because it's short term. If I want to generate cash flow by selling options, that's a great way to get paid to acquire gold. Sell my gold now, that's not good news. Because that means I had to do it because my dollars are not worth anything.
Money Revealed is an exclusive video series where self-made millionaires share their secrets on how they got rich. In this episode, you'll learn powerful strategies to create real wealth, shift your money mindset, and the key lessons for massive success. These are the lessons that they don't teach you in school about making money. And we've partnered with the series creator Jeff Hayes to bring it to you on my YouTube channel. Enjoy.
Over a period of years now, I've had multiple conversations with Andy Tanner. And Andy is sort of deceptive insofar as he seems like this good old folksy kind of guy with a simple outlook on life. But his strategies for earning money in markets, no matter what's happening, are significantly brilliant. And what his expertise is taking complicated things, simplifying them, and then teaching them to people like you and me. Recently, I had a conversation with Andy in the midst of all of what's going on right now, very tumultuous time, and I asked him, okay, what are you doing now with this world that we're living in? And how has it changed your strategies? As it turns out, he's actually doing extraordinarily well right now financially, and I want him to share that information with you because you can do it too. So enjoy this interview with Andy Tanner. Andy, we've had several conversations at this point, and there's not a single one that I don't walk away from smarter. So, so thanks for sitting down for yet another one on what I think is a really important topic right now.
Wow, thanks so much. It's always been fun to learn from what you guys do, and it's so important. So thanks for having me back.
For sure. So just in case there's people who maybe aren't familiar with you and your background, let's just do like a quick thumbnail and talk about how you got to be doing what you're doing now.
Well, I imagine I would resonate with most people as far as growing up. People would say the same things to me that most people hear. What do you want to be when you grow up? And get a job, get good grades. And I failed in every one of those categorically. And when it came time, I played a little basketball. I went to college. I never found what I wanted to do, and I couldn't jump and I couldn't shoot. But,
you didn't have to. For those who can't tell by the framing, little basketball. You walk in, and I saw him. I said, "There's Andy," because he's 6'8".
You duck through the doors once in a while.
You got ducked through the doors.
And I was a horrible basketball player, but I could foul people, and so they'd find a spot. But when that was all over, I never found. From accounting down to zoology, I never found that major that lit me up, and I wound up in sales and enjoyed that. In the 90s, when the online trading came, I found myself selling, those types of softwares and trainings, and it got me interested in investing, thank heaven. And so now we have the Cashflow Academy, and for the past 20 some odd years, I've been an educator, an investor, and most of all a student, because I'm still learning every single day. But we have the opportunity to help as many people that want to learn more about money investing. We share what we've learned so far. So that's us.
So we're in interesting times now. I mean, we've had interviews, pre-COVID, and we even had some conversations along the way when COVID hit and the market crashed down.
Yeah.
And then now, at the time of this recording, market is not all the way fully recovered, but it's close to where it was.
Yeah.
We're in the, moving into like some very polarizing political circumstances, et cetera.
Yeah.
And all this, I think, gives new considerations for investing and what type of investments people might do. One of the things that come up that I've seen you start to speak about recently, which is, I think, a very hot topic, is gold. So
Yeah.
what got you interested in gold?
Well, I'm lucky. I spent time as a rich dad advisor, and so I have to credit Robert Kiyosaki for encouraging me to learn a little bit about gold. Mike Maloney's been a great friend, and my grandfather was a gold bug. He lived in Germany, was part of that Weimar Republic, and when I was a kid, he would talk about those wheelbarrows full of German marks, to get a loaf of bread. But what makes me interested in gold right now more than anything else is what's happening to our currency. Right now, I feel that at least the United States, the U.S. dollar, what's the future of that right now? One of the things that we hear a lot about is modern monetary theory, that MMT.
Yeah, what does that mean?
Well, modern monetary theory changes fundamentally what a dollar is. I'll give you an example. There's a man named Warren Mosler who's sort of some people call him the father of MMT, and I'll tell you how he runs his house. He has some business cards, and his children have to turn in his business card back to him every month, like a tax. Say, hey, you got to give me your business cards. And the only way they can earn those business cards is to do chores around the house or they lose their privileges. So it's a very authoritarian household. It's not, here's an allowance, work, and go spend. It's like, you will lose your privileges if you don't get these business cards. That's what's happening to taxes. Think about that, Patrick. Where a dollar isn't we've always thought it represented something else.
Right.
Apple just split their stock 4 ways. Well, it represents ownership in a company, so it would make sense that the price would be cut by 75%. That makes sense. If I give my keys to the valet and I get a valet stub, I don't get to print those. There's only one car in the valet. But what MMT says is, no. That's not what money's for. Money has no intrinsic value. It doesn't represent something else. The way we keep it valuable is we tax you. And if you don't pay your taxes, you'll go to prison. So that's one thing. And then as they print the amount of money they're printing, under this idea, and where Jerome Powell is on this, he is the Fed chair. As I listen to him, I'm like, well, is he a modern monetary theorist? And as they talk more about it, no one's coming out and saying we're adopting MMT, but I do see penalties for taxation. I do see lots of spending. I don't see it backed by anything anymore. And so with that uncertainty, I think to myself, do I want some insurance with some confidence on something that people have traditionally found to be pretty valuable, which is gold.
So to dig into that just a little bit.
Sure.
When you say that what makes a dollar valuable is the ability to tax.
Yeah.
Meaning, like, why does this thing have any value, or why would we believe that this is backed by the full faith of the United States government, right? Is that because they have the legal power to tax a workforce? It's
kind of frightening. A lot of people argue against MMT because they think it wouldn't work. I'd be more afraid if it did, because it really attacks property rights. So that's political, but more importantly, if another way Warren Mosler will put it is he'll hold up a business card in front of a group of people, say, anyone want my card? They say no. They say, well, I got Guido out in the hall. He'll gun you down if you don't walk out with one. Oh, now we want one. So rather than the demand of a dollar being, hey, we want these because it represents something, it's more of, well, I got to get some if I'm going to pay taxes. And
But if I don't work or I don't produce, I don't have to pay taxes.
Yeah, well, I always wondered why I had to pay them if we can print money anyway, right? And that's very, very true in that type of a theory, right? The other part of that theory, it begins with the threat of taxation and penalty for tax evaders. That's where MMT begins. But I guess the next step would be the monopoly of creation. I mean, you and I could go out and maybe pan gold in the mountains, or we can find some gold somewhere.
Right.
No, this actually could be more valuable than gold in a way because they're the only ones that can make this. So the thing that I think makes some people nervous about it is what's going to happen to my property rights and what's going to happen to taxation and where do we go politically. But more important for me is I'm not sure whether it works or not, how well it works, and where that dollar will be. And so the interest in gold, again, is just, do Do I have something other than a dollar that I can say, hey, here's some wealth that I have, and rather than just a currency, a US dollar.
And that equates to dollars in some way, saying, in other words, this is something I possess that's an asset and it has a certain amount of value in dollars.
Yeah.
But I guess, what is the practical application of the modern monetary theory? So you're saying, okay, I guess a part of it is we can produce and print money at will, without consequence. I mean, what is
their idea?
How does it apply?
Their idea is that they actually think there's untapped potential. I mean, well, think of it this way: if you were in a war with China, trying to get to AI, think space race. John F. Kennedy, we're going to get the moon first. So Russian, you have space race. What about the AI race? Is winning that worth printing $12 trillion to get there first? Curing disease to get there first. And so their thought is you look at employment, they say, look, if we can invest in areas and create anyone that wants a job to have a job and have, what we basically say full employment, well, that's going to be better for the communal, community, the society as a whole. And so by printing money, you create jobs, you create full employment, and then prosperity and free healthcare and free education, free everything. So it sounds very utopian, but it does come at the cost of personal property rights.
Oh, so draw that line then. How does that head to personal property rights?
Well, it's the taxation, because if you put dollars in the system, how do you get them back out? Well, you got to tax them back out. Even if you loan money, in the form of a bond, which is, an asset to other people. They're creating an asset that is fairly, people have a lot of confidence in to take their side. But in order to get money back out of the system, if you print it, how do you get rid of it? Well, you taxation. And that, they say, well, who's got the most? Let's figure out ways to get the money back out and reduce the money supply by taxation.
But
So
if I take, there's a certain amount of dollars in circulation. If I take $3 trillion, print 3 trillion new ones, put them in, doesn't that devalue all the other dollars proportionately?
you would think so. I mean, that's my personal opinion. What I really look at is the amount of goods and services. If the amount of currency becomes disproportionate, the amount of goods and services, well, obviously, supply and demand would say that those dollars are reduced in value. What they tend to believe is, well, yeah, but we have so much more room in workforce of what could be produced. And their idea is spend first. And it's a very backward idea to how you and I think about it, is they don't think of it the way you and I do. It's kind of a new theory, and it makes me nervous about what could happen to that currency. Because like you say, over and over and over, look at Venezuela. Chavez, they're sitting on all the oil. And instead of a printing press to print money, he had an oil well to print money.
Right.
And so he won the country over with programs, and very much a champion of the people, particularly those who were less fortunate. You know, gas, you walk up to the gas pump, it's, fill it up, we can free gas and everything else. But when the new regime took over and that plummeted, the support for all that had to be done by printing the money, and now you have Venezuela, which is what Charlie Munger says. They say, what do you think MMT, Charlie? He says, it ends like Venezuela. And that's not some crazy guy.
Yeah.
That's Charlie Munger's been around for 100 years doing business with Buffett.
Yeah.
So, do I know whether it'll work or not? No. Am I an expert in MMT? Absolutely not. But I've learned enough about it that I think, okay, my confidence in a dollar, particularly over COVID and the rate we've printed these and more rounds of trillions, trillion-dollar packages of debt, it at least raises my eyebrows to say, well, would I want some insurance? And that's a great segue into this idea, because I don't look at gold as a way to make money. And that's very important. I mean, if there's one point I could make, it's that we're not in physical gold to buy low, sell high, and make a lot of money.
Right, you're not trading it.
Not at all. In fact, to me, I look at this as an expense. It's an exact mentality of my car insurance. Why do I pay that expense? Well, if something bad happens to my car, I'm taken care of. My home insurance, if we have a fire, I'm taken care of. I look at gold as wealth insurance. I don't ever hope I sell that gold, because when would you know when to sell anyway?
Right.
I mean, I bought a bunch more at the beginning of the pandemic when it hit our shores here in the United States around March or so. On March 24th, the Fed said we're going to print a bunch, and I said, all right, let's see if there's any gold left on the shelves we can even get at this point.
Right.
So we went down and got some physical gold. The best case scenario is that my great-great-grandkids inherit this. One thing that's nice about an insurance policy is my car insurance will run out, I got to pay more. That gold tends to stick around. It's got doesn't have an expiration date on it. But I'll tell you, if I sell my gold now, that's not good news. I mean, because that means I had to do it.
Yeah.
Because my dollars are not worth anything. So when a person watching this, what they're saying is, their mentality is, well, how does this impact me, right? What do I do with this information? Well, the first thing you have to ask yourself is, do you want to preserve wealth, or do you want to increase cash flow? If you want to increase cash flow, unless you're a insane technical analyst that can buy and sell Bitcoins and buy and sell gold, there's no cash flow for you there. It is going to be an insurance only if your dollar loses value. And that's the way I look at it. But I'd rather have insurance. The only thing worse than having to cash in your insurance is not having any insurance.
Yeah,
when you need it,
right.
So that's where I feel about physical gold. But there are other things, like Warren Buffett has done interesting things with
Talk
it.
about that.
Well, the headlines, I mentioned that my grandpa was a gold bug, and that was quite literal. He was a metallurgist, and OSHA probably would have had 10,000 fits, but he had a shop out back, and that's probably why I'm so goofy. I got mercury in my veins and everything else. But he always had bars of silver, and he would help people assay minerals. And they'd bring their rocks, and he'd crush them up and melt them down and see what was in there for them. So yeah, scale up if you want. That was his thing. So he's always had gold in my hands as a kid, either silver or gold in my hands as a boy. So, I'm a gold bug, I guess, that way too. But when Buffett bought shares of Barrick Gold, which is a mining company, one of the largest in the world, everyone said, Buffett's buying gold, Buffett's buying gold. Look, finally he's seen the light, Buffett's buying gold. Well, slow down a little bit. Number one, the percentage of his wealth put in that company was very, very small. Number two, he still holds a lot of greenbacks. He's got a ton, he is sitting on a ton of cash, and we might be able to talk about that as well. Why would he have some cash? But here's what's interesting about Barrick, and I can't read Buffett's mind, but as I watched him make that move, I asked myself, okay, why would he do this? And do I want to copy him? Do I want to do the same thing? Well, when you buy Barrick Gold, you're buying the mine. So you're buying wholesale. And think about that for a moment. Right now, as we speak, as of this recording, I would imagine you get a gold round, American Golden Eagle, for around $2,000, give or take, a couple thousand.
Yep.
Is Buffett the type of guy to play retail? Obviously not. He's going to buy it in the ground.
Right.
Well, in the oil business, they have something called a lifting cost. How much does it take? I own the ground now. What does it take to get the oil out? Well, there's the same thing is true with gold. Barrick pulled it out of the ground last year at about $1,000 an ounce.
Okay.
So that's his new price on gold locked in. And we might have some inflation, but his price to get gold out of the ground now is going to be around $1,000 or so. So he's not a buyer of gold, he's selling at retail. He's selling to the gold bug. That's $1,000. Pull it out of the ground for $1,000, sell it for $2,000. If it goes to $3,000, he's selling it for $3,000. If it goes to $4,000, his margins increase, which means his dividend would likely increase.
Right.
So Buffett's not buying gold, is he? He's selling it.
Yeah.
So if you want gold for protection, well, go buy some physical gold. Stick it in your safe.
So do you think, as you said, you can't read his mind?
Yeah.
But maybe what he's anticipating is retail demand for gold is going to go way up, even just the psychology of the market is such. And therefore, let me get in on the wholesale side, and I'll be happy to supply for all those people who want to buy.
Yeah, I think, the way he thinks, you look at his non-public companies, Fruit of the Loom and Geico and Duracell and all those. He's saying, is there a market for this right now, and do I think people will buy this from me? Right. He's always been about business, and he's always felt that a good business is the best investment you can make because the margins are so high,
Yeah.
right? A can of Coke doesn't cost that much to make,
Right.
and yet with inflation, it's probably the same as a Coca-Cola play. You know, if we inflate, Coca-Cola is more expensive, so is gold. Well, I want to be a wholesaler and a retailer of things that are in high demand. So I think we're safe to say that, even though we can't read his mind, if you look at how he's thought all along, he's getting in the gold business.
And I guess there'd be somebody in the middle because it's getting it out of the ground, then it's getting it to maybe the wholesalers, and the wholesalers are going to retail it, like the mints or what have you. But here's the thing that I wonder about when people are thinking, like you said, hey, I've got my insurance policy, I'm buying gold. What's interesting is that it seems that the Fed's manipulation of the market can dictate what the price of gold's going to be, at least for some period of time, until maybe they can't hold on to that anymore. What do you think about that?
You know, Jim Rickards talks a lot about this. He says, we'll just make it $5,000 an ounce and see what happens. I mean, the Fed could set the price and say, the Fed can buy anything they want. They started out by buying government securities, and then in 08 and 09, they said, well, let's get into the mortgage business and start buying private types of things.
Right.
Janet Yellen, former Fed chair, has said, let's start buying stocks, and buying equities, and that could happen. So there's no question they could do the same thing with gold, and they could do that. They could say, okay, gold is now $5,000 an ounce because we're willing to print a bunch of money and buy a bunch of it. And so now if you have gold, you have to say, what am I going to do? Am I going to sell it to the Fed for $5,000, or am I going to hold out for more now? Right. So you're right. The Fed essentially could set the price on anything they wanted to. And perhaps the way Buffett feels about this is says, well, with the MMT and the printing of the money and everything like that, maybe there's room for gold to increase in value. If I own the gold mine, that puts me in a pretty nice position.
Yeah.
If they want that commodity. So I'll be a seller of gold and a wholesaler of it.
What's interesting also about the Fed is that for the economist who's really good at fundamentals and looking at all the varying variables that drive an economy and can anticipate what will happen in the markets broadly or maybe in individual companies, it seems like all the intervention of the Fed makes those people sort of blind. I mean, it's like you can be a really good economist, know how to get to a certain outcome and what should happen. Next thing you know, the Fed says, "Oh, we're going to dump $3 trillion in here."
You make a great point here, Patrick, for an asset like gold, because of the uncertainty. I don't know if I've heard this or why I use this phrase, but I call it a detachment from fundamentals. And I've seen this more blatantly during COVID. When you have the Fed pumping that amount of money in, stocks are cheap. They're cheap right now.
Right. You think they're cheap?
Oh, if we're going to keep printing like this, I know they're cheap. And if we say...
So does that mean that...
They're way cheap.
Are they cheap because the dollar has less value?
They're cheap because if you're a fund manager on Wall Street... Let's say Jerome Powell announces that they're going to start buying equities. You can lose your job if you're not exposed to those equities because here's the problem. And what I mean by the detachment from fundamentals, this might be for people watching that are beginners in fundamental analysis. That's heavy stuff.
Right.
I often say, picture a little Jack in the Box. And you turn the crank, and instead of a clown popping out, a dollar bill comes out. So it's a little money-making machine, a literal money-making machine. That's a great way to think of a business. Yeah. Warren Buffett looks at it that way. Oh, Dairy Queen, sell some Dairy Queen Blizzards, and out comes a dollar.
Right.
So the problem I have now is if it were just like Fruit of the Loom and like Dairy Queen, that'd be just fine. Warren Buffett doesn't get up in the morning and say, well, how much can I sell my box for?
Right.
He's in the underwear business. He's in the battery business. He's in the home furnishings business, whatever the business might be. But the moment you put that thing on Wall Street and say, oh, there's a price tag on this right now. Oh, I'll spend $15 for that box. And if it makes me $1 a year in 15 years, I got my money back. Great. That's traditionally what the S&P's been at historically. It costs you about $15 to buy a Jack in the Box. They'll give you $1 every year. That's what it's been traditionally. But once you begin...
So-called PE ratios.
Yeah, it's price to earnings, right? Price is the price of the box. Earnings is the dollar that comes out, exactly. But the problem is once you put this in a market and you have Tesla, you think, well, maybe they'll be more valuable later. And you see the price starting to go up. You know, their PE ratio as of this recording is $1,200.
1,200 to 1?
1,200 to 1 as of this recording.
Wow.
So they've got a lot of earning to do. Now, I love Elon Musk, and he's changed the world and will continue to change. I love his company. But as an investor, do I say, gee, I'm going to spend $1,200 for, that's a lot of growth we're hoping for. So what I mean by the detachment from fundamentals is if all of a sudden the Fed says, we're going to buy boxes. And not only that, you know how we bought the toxic assets? We bought the worst box?
Oh, yeah.
Well, let's buy the worst ones. Well, now the demand for those boxes will go higher regardless of the money they're spitting out, because now there's a demand for the box itself. Not driven by the money coming out or the possible growth, but simply because there's money flooding the market, up asset goes. If that's the case, stocks are cheap right now.
But that indicates to me, at least, that means the dollar's devalued. The company isn't really worth a bunch more today as it was,
That's right.
a week ago. It's the same company with the same performance, so it's not like suddenly they're worth a lot more.
That's
So
right.
if their stock is trading higher, then it just tells me, okay, the dollars must be worth less, and it's why it's the same quanta of value, but it's got a higher price.
Takes more
on it.
dollars
Yeah.
because the dollars are worth less. Takes more dollars to buy that. That's exactly right. You know, a lot of what these people and MMT and all these people think is, well, it's really what you spend it on, isn't it? And they say, look, all this printed money has gone into real estate values. It's made the rich richer. Those that are exposed to this are going to demand more of those dollars to give up our stocks to trade with each other.
Right.
And so it's made the rich very, very rich. And I think that would probably continue if the Fed says, oh, let's buy equities now, And the same thing would happen with gold. Think about it. If all of a sudden they say, we're going to buy gold, the fact that they can create the demand. That's what I mean by the detachment from fundamentals
Right.
and free markets, because they're manipulation. And it could be that they're getting weaker. They have so much power perceived now. Oh, they can manipulate this, they can raise interest rates, they can print money, they can change the fractional reserve requirements. They have all this power. But the more they use that power, it almost seems the weaker they become. Are they making these decisions because they really want to, or because they feel compelled to keep the thing going? It seems to me that we're in a deflationary situation for sure for two reasons. Number one is the velocity of money. If you bring up a chart of money supply, it's at an all-time high. If you bring up a chart of velocity of money, it's lower than it's been in the history. The chart I've seen goes back to 1960.
So what is velocity then?
The velocity of money is how often a dollar changes hands per quarter. So right now it's 1.2. So it takes 3 months.
Does that mean people are just holding their money?
Yeah, two things. Number one, the wealthy tend to accumulate more cash than they can spend. How many Ferraris are you going to buy if you're a billionaire? But the other part is COVID has stopped us from spending because of the restrictions that have been, you shut down an economy, it stops. And that drops GDP, and that's deflationary. All of a sudden I need money, I want to save money, I want to put it on the mattress. It's not something I want to get rid of. And so while the public is wanting to hoard money, save money, I'm worried about money, the Fed says, oh, well, great, if they're going to hoard it, we can print more of it. And it almost seems that the idea of a currency that moves, it's almost turning into an ocean of money where there's so much of it that it's hard to move,
Right.
like an ocean. The velocity is an interesting thing to think about.
So if there's deflation, as compared to inflation, what does that mean then? The dollars are worth more, or does it mean what is
Yeah.
Because people say I'm afraid of deflation, or that's a bad situation. What does it mean, or does it mean the price of goods and services come down?
That's right.
Because not enough money is going around asking for them.
Yeah, I mean, if you're a business owner and all of a sudden your products aren't selling because people are hoarding dollars, what do you have to do to get their dollar?
So you lowered the price.
You have to,
Yeah.
in order to get their dollar, because everyone wants the dollar. Flip that around. What if no one wants the dollar? What are you going to do? If you don't want the dollars,
Yeah.
you're going to raise your price, say,
Yeah.
well, I don't really want these, so you better give me a lot of them
Yeah.
if I'm going to give up my cool stuff. 1929 was deflationary.
Yeah.
Right? It was deflation. And the Fed has made it very clear, Jerome Powell, very clear, that is not the road we're going to take. So maybe it's not a balloon that pops. Maybe it's a balloon with a hole in it and air's escaping, and we're trying to pump in air faster than it's leaving.
And the hole keeps getting bigger.
Yeah, and the hole keeps getting bigger. And thus the Fed has to pump harder. And that's why I say, almost it seems the more they use the power, the weaker they become.
I think that there has to be a day of reckoning, I'd imagine. I mean, you can't just infinitely print money and continue to have it have value. So what, go circling all the way back to the beginning, and then we'll get right back on gold with it, because I think all these things are the considerations as to why gold, right? But,
for sure.
You talked about your grandfather, in Germany walking around with the wheelbarrows of cash for a loaf of bread.
Yeah.
What was the circumstance that created that? I guess they call it hyperinflation. What was the?
Well, the Weimar Republic, and I'm not a historian, so I'll do my best on this, but the Weimar Republic after World War I got in some pretty bad treaties with some of the other countries, and I think France was part of that, and probably England, where they just couldn't pay it. And that leaves room for a dictator or someone to rise up and say, well, I've got a better way to do this. But you have Zimbabwe, which is very famous. You've got Peru did it twice in the 1980s. Our currency here in the United States actually hyperinflated once. People don't know about this. Before there was a dollar, there was a continental. And George Washington says, well, we're fighting the people that give us pounds. So that's a problem right there. We need to get our currency. So the Continental Congress came up with a little script called a Continental. And actually, a lot of people don't know this. The Brits forged these and counterfeited these and put them into
wow.
Pretty easy to forge back in those days.
Yeah.
And it actually caused the devaluation of the currency, hence the term, not worth a continental and good as gold.
Wow.
So kind of interesting stuff.
Yeah.
The South in the Confederacy printed their money. So there's plenty of precedent for people that have printed money and to the point of hyperinflation where it's lost its value.
Yep.
Where that holds for the United States, it remains to be seen. Again, it's modern monetary theory. Is it modern monetary fact?
Yeah.
Time will tell. I don't know the answer. I'm not smart enough. You'll have to interview guys.
I don't know if anybody's smart enough to know
Yeah,
that.
I mean, you'll have to interview people smart enough for me to know. But this is what I do believe is that people seem to have liked gold for a long, long time. It's fungible. It's hard to find. It's shiny. It looks nice. It's got an industrial use. Seems to be a pretty good thing that we've traded over time. So I'm not putting everything I have into it, just like Buffett isn't. But I think it's it's not a bad idea. I feel better knowing I've got a vault somewhere with a little bit of gold in it.
And you recommend physical gold. In other words, if you're gonna create this investment, take possession of the gold, or silver, I guess is another one that people can do.
Let me qualify that.
Yeah.
If we go back to what you want and what your goal is, if your goal is cash flow, that is a bad idea.
Right.
If your goal is insurance, it's the best idea to have physical. There are a lot of things that swirl around paper gold and derivatives of gold, such as ETFs. And the gold bugs that's just, we don't want to talk about those at all. Those are horrible. They're not legitimate. Well, no, they're legitimate for different reasons. If I want to trade, I'm trading that because it's short term. If I want to generate cash flow by selling options, that's a great way to get paid to acquire gold, which would be a great conversation for us to have sometimes. So if you're like Warren Buffett, you want to be in the gold business of buying wholesale and getting dividends off profits. So it depends on what you want. Do you want a company that owns gold like Buffett and be a stock investor, which is really a real estate play because you're buying a mine, you're buying ground or at least mineral rights? Do you want to have insurance? Physical for the insurance for sure, physical. But that has its problems too. Where are you going to store it? You can put $1 million of gold in your house. How good's your security system, right? If you're Robert Kiyosaki, I guess you got a couple of shotguns, but that only goes so far. So you got to store it. Do you really have it in your hand? All those questions are there to be asked. But I do believe some physical gold as insurance against an uncertainty of our currency. And I would encourage people, to the best of my ability, if I could summon language to be persuasive, study both sides of that coin. Study what's happening. Study not in a dogmatic way of what's right or wrong, but just say, you know what, I'm gonna read a little bit on MMT so I can understand the fundamental shift that seems to be occurring on what money is and why it would remain valuable or not. And the more someone educates themselves on that idea, I think the better they'll be able to navigate the future. At least that's what I'm trying to study as a student.
And there's actually a lot more I want to talk to you about, but all of this framework and backdrop I think is really important to understand the dynamics of what's going on today, some of the historical precedent that you had pointed to, et cetera. Gold as an insurance policy, and I personally have invested in gold and silver myself, physical gold and silver during this time for the same reasons that you just described. But another area that I think is a huge area of opportunity is options trading, and this is, I think, probably what you're best known for, or one of the things you're best known for, at least.
Sure.
So I want to, now that we have all this background, I want to tease people into part 2 of an interview with you that we'll do on options trading. So if you don't mind, I'd love to have that conversation with you.
That's an exciting thing. Right now, the environment lends itself to those types of instruments. Got to be careful. The reason people watch, this interview, but even more importantly, all of the amazing people that you guys bring together, is to increase their financial education. Right. And this option trading can be an interesting part of that. As a person looks, say, well, what are my next moves going to be? That can be a really interesting thing, because it brings a lot of leverage to the table without debt.
Yeah.
And so we can speak about those and get as complex or as simple as we want. You mentioned I'm known for trading options. I just think that we've had an ability to make it simple for people.
Yeah.
And so hopefully in that interview we can start with some baby steps and explain what it is and why that might be or might not be something for that particular person.
Well, thanks for bringing all that up. So for those who are listening, you want to definitely tune in for part 2 of this interview. So Andy, thanks very much.
Thanks so much. It was awesome, as always.
My next guest is Doug Andrew. This man has a reputation that precedes him. Before I ever met him, people would speak in glowing terms about him. He does financial planning and management for some very successful and actually some people that are big name celebrities, and there's a reason why. He's really, really good at what he does. He's engaging. The time flies by when you're listening to his brilliance and his flow. So let's not take any more time talking about him. Let's dive right in. Doug, I'm really looking forward to this conversation. A lot of ground I want to cover, so I hope you're ready.
I am.
All right, good.
Thank you.
Good. There's so many things you know about in the realm of financial strategy, and I think it's going to touch a lot of areas that we delved into in this particular series. So let's just start with you first, though. How did you get into the type of work that you're doing?
Wow. Way back, about 50 years ago, my intention was actually to become an estate planning attorney. And as a means to that end, when I was at Brigham Young University, I got my insurance license and my Series 1 securities license to sell mutual funds and stocks and bonds and so forth. They don't even offer that license anymore. It was the granddaddy of them all. And so part-time, I went out and began to meet with clients, prospecting door to door and what have you. Even though it was tough, it ended up being something I fell in love with. In fact, I made 30 grand part-time my first year as I was a student, and I was in my junior year. The next year, I think I made 72,000 or something, and I think the professors were making 40,000 at the time, and I went into the dean, and my wife had been in the hospital in intensive care, had some serious surgeries, nearly passed away. In fact, technically did twice and came back. And so we ran up all these medical bills. So I had to put college on the back burner a few times, and I supported myself in the hours that I did have by going out and meeting with clients, helping them to optimize their financial assets. Well, he said, how much could you make if you were full-time? I said, 150, 200 grand. He goes, "What are you doing in college?" But I went out and I fell in love with it. I've never looked back. And I have been so blessed, Patrick, rubbing shoulders with some of the top entrepreneurial financial gurus in the world. And so I've learned a lot by osmosis. Yes, I went and got my schooling and all those degrees, but really I learned more from rubbing shoulders with brilliant minds.
So is there an overriding philosophy to what you do? I mean, that you'd say, this is just the lens I look through that kind of drives everything.
Yes. Most of what I do is not termed conventional wisdom, okay? And I help people optimize all of their assets on their financial balance sheet, but also their family balance sheet. And that's what probably makes my approach unique. My company is called Live Abundant. And the reason for that is, for a lot of years, Patrick, people would come to me to optimize their financial assets and minimize taxes. I'm a tax strategist.
Right.
And I've saved people, hundreds of millions of dollars of unnecessary tax. If I were a physician, I probably spent most of my career curing different types of diseases. Now, the word dis-ease means you're not at ease, dis-ease. And we think of that physically, okay? But people have a lot of financial dis-ease, and they follow the herd. So in answer to your question, when they're thinking about money, they're going out there and many times they follow the herd and they just almost get duped, I think, into, just sock away money in traditional tax-deferred IRAs and 401ks because you're going to be in a lower tax bracket when you retire. That has not been true or axiomatic for over 25 years. Do you know, Patrick, it took the financial services industry until just 3 years ago to finally admit that's been the wrong advice.
Wow.
Now, let me ask you a question. Do you know what a fiduciary is? Okay. A fiduciary is supposed to look out for their client's best interest ahead of their own, okay? And what bothers me sometimes is a fiduciary will hear the client say, yes, I'm doing very well, and I'm socking away all this money, and I've got $1 million or $5 million bucks, but now I'm going to retire. I'm not in a lower bracket. I thought that was the premise. They're in as higher tax bracket as they've ever been in. And so they go, was that good advice? Were you looking out for my best interest? Why didn't we do something different? So what I would help a lot of people do is cure the tax disease or that corner they painted themselves into to get their money out with the least tax consequence and convert it at least up to 60% of their retirement resources to vehicles that are tax-free, that are immune from the dangers of taxes, inflation, and market volatility.
Yeah. Well, so now there's a lot of topics to talk about, but we're on taxes, so let's look there.
Okay.
Because for the let's say the average professional, somebody who earned higher than let's say the minimum income or the middle income is, but they've made some money. They're professionals. They're doctors. They're lawyers. They're accountants. They're entrepreneurs that have earned, et cetera. One of the things I've noticed after decades of being an entrepreneur is that really trying to accumulate wealth is difficult because you have to pay taxes. And by the time you try to live any kind of a lifestyle, right, you raise some kids, maybe put them through college, and you pay your taxes, it's really hard to, the taxes are very oppressive to wealth accumulation. So what do you think some of the tax strategies, for people out there looking for them, what are some of the, maybe what's some of the low-hanging fruit? What are some things that they can get themselves into that would be worthwhile?
Yeah, very good. When we're talking about the money we sock away for long-term goals like retirement, okay? So let's talk about that one. Many times, again, people think, well, I want to use 100-cent dollars, pre-tax dollars, to contribute into a traditional account like an IRA or 401k. Now, sounds good, but let me use this little metaphor. If you were a farmer, Patrick, and you had the choice of buying your seed in the springtime, and you didn't have to pay tax on what you paid for your seed. So you plant your seed, you cultivate it, you water it, you work hard, and in the fall of life, you harvest. And now you agree to pay tax on what you sell your harvest for. That's a traditional IRA, 401k, pension, profit sharing plan. You get a tax break on the seed money, It accumulates tax deferred, and then you're supposed to take it out and pay tax on it on the back end. It's the best savings bond the government ever came up with for themselves. Wow. See, people don't realize Uncle Sam has a permanent tax lien on that tax-deferred IRA or 401k. So it's not all your money.
Right.
So when people would come to me, and I've coached many successful entrepreneurs and doctors and dentists and orthodontists and chiropractors and also realtors and CPAs and tax attorneys, and they would come in and they would almost thump themselves on the chest, okay? Well, I got $1 million here in my IRA. And I go, well, that's not all your money. I ask you to bring your after-tax IRA 401k statements. Well, I don't know if I've ever gotten one of those. Oh, let me calculate that for you. See, this million isn't all your money. Only about 650,000 of it is yours.
Wow.
See, if you have $1 million and you are earning, you think you can earn 10%? Yeah. Well, so 10% on $1 million, you should be able to pull out $100,000 a year into perpetuity and never deplete the $1 million, right? Well, so you pull out 100,000, and all of a sudden you owe tax of 25,000 or 30,000. So you only have 70,000 left over to buy gas, groceries, prescriptions, golf green fees. Well, I needed 100. So you go back for the 30,000 you were short because you paid tax. Okay, now I got that 30, and you go, hold on. No, Uncle Sam's going to take 10 of that 30,000. So you only have 20. So you're still 10,000 short. You go back again, and you pull out another 10, and they take 3,500 of that, and you go back and forth, and you go, well, this is stupid. How much should I have pulled out in the first place to net, 70,000? Well, you should have pulled out probably about 150 grand, okay? You pull out 150, you pay tax, let's say, of a third of 50, you're to net 100. At a 10% rate of return, Patrick, that $1 million nest egg will be totally gone, drained dry in 11 years.
Wow.
If that $1 million were tax-free, you pull out 100,000. The IRS knows you're receiving it. My clients know they receive 100,000, but it's not deemed earned, passive, or portfolio income. Right. Those are the only three types of income since 1986 that are taxable on a 1040 tax return. So it's not a tax loophole, but if you pull out 100 out of my favorite vehicle, which I call the Laser Fund, which is the title of my most recent book, you pull it out and it's tax-free, so you can spend the whole 100 grand. So in 11 years, when people with the same $1 million don't have anything left, and you're going to live to 96, that's 20 years. Now you're going to rely on what? Social Security, welfare, or your children for support? Right. No, who wants to do that? Right. If you had a nest egg that could generate 100 grand a year tax-free, it doesn't deplete your principal. That's 20 more years of 100 grand. That's 2 million. Right. And you still have your principal of $1 million. So what I would do is help a lot of people not outlive their money by switching or doing a strategic rollout from things like IRAs or 401ks with a three-part strategy. Let's get it out of there. Let's get the taxes over and done with sooner than later. Because two things are certain. Money will never be worth more than it is today because of inflation, government spending, and so forth. And number two, your current tax bracket is likely the lowest bracket you will ever be in. So why do you want to postpone tax, defer it to some future perceived unknown advantage, and then take out your money when you're convinced taxes are not going to be lower?
And that's the big lie, isn't it? About, as you said earlier, is that your taxes are going to be lower in the future, so accumulate your money now, and then you're going to pay less tax. But is the tax in the future, whatever that future is it based on the amount of money you're pulling out, or the amount of income you're making now, or is that seen as income when you're pulling it out? Like, why is the tax bracket going to be high in the future?
Good question. It's because a lot of people have been going down the highway of life, trying to achieve financial independence with one foot on the gas pedal and the other foot on the brake pedal. Does that sound smart? Let me explain it. So people think I'm going to use 100-cent tax-favored dollars on the seed money, traditional IRAs, 401ks, because I'm going to be in a lower bracket because I'll be earning less. Let's take a school teacher, for example. A school teacher, typically in most states, if they taught school for 30 years, they will get, under the state pensions, 2% for every year of service they taught school. So if you taught school for 30 years, 30 times 2% is 60%. Let's say a school teacher retired making $5,000 a month. Well, they're only going to get $3,000 a month on their defined benefit pension. And they go, well, I can't handle that. So what do? They sock away excess money, which they should, in supplemental accounts like IRAs, 401ks, 403bs, tax shielded annuities, and what have you. I can count on my hand the number of people who were in lower tax brackets when they retired. If you're in a lower bracket, it means you didn't save very much. So what happens is the other foot on the brake pedal is they kill their deductions while they're doing it. So most people pay off their house. You don't have that tax deduction anymore. They're not contributing money in retirement to IRAs, 401ks, and 403bs. You don't have that deduction anymore. The kids are gone. Or if they're not gone, you can't deduct them anymore. Okay? Or if they're a business owner, you don't have those deductions anymore. And Congress keeps raising taxes over and over again. So that's what I mean. You had one foot on the gas pedal trying to save and defer to a future date when you thought you were going to be in a lower bracket, and then you hit retirement and all your deductions are gone because you had the other foot on the brake pedal. And then people pull out that money and they have to pay tax. And so many times people don't need their money, but at age 70 and a half, if you do not withdraw out of an IRA or 401k or any of these plans, what the government says you're supposed to based upon your LE, that's life expectancy, guess what the penalty is?
There's a penalty for it?
50%.
So
If you're supposed to pull out, let's say, 50 grand starting at age 70 and a half, and it goes up each year, okay, 50 grand, and you don't, the penalty is 25,000, 50% of what you should have pulled out, plus you pay full tax on the whole 50.
Wow.
See, the government wants that money out and taxed before you die so they can tax you again when you do die because it's the best savings bond they ever came up with for themselves.
Wow.
And so I would switch that philosophy. So in 1997, under the Taxpayer Relief Act, there was a senator by the name of Harry Roth. Okay? And at the time, the government was hard up for money because the government loves to start cashing in and getting their piece of that action.
Right.
See, if you and I were a business partnership, and I come to you and I say, Patrick, okay, this is the deal. We're going to go into a partnership together. Now, you're going to do all the work. And you're going to build this business, and I own a third. Okay, I'm a third partner in this thing. And here's the deal. If you sell out or try to get out of this partnership prematurely, I'm going to get my third and penalize you 10% on top of that. See, an IRA or 401k, you're penalized 10% if you touch it before age 59 and a half.
Right.
But down the road, when you begin to liquidate the business, I get a third of it. But if you don't sell it by the time I want you to, then I'm going to penalize you 50%. And by the way, I reserve the right to change the percentage if I feel like I'm more hard up than you. I can change my percentage to more than a third, up to 40%, and force you to pay me more. Is that a good partnership?
First of all, I had no idea that they could change it on you, meaning that you could have planned for decades and then they can just change it and there goes your plan.
They can change, well, government changes tax rates all the time.
Right.
They can change the percentage they want. They can change when they have you access it and so forth.
Wow.
And people go, I would never go into a partnership like that.
Wow.
And if they haven't got it yet, I go, I just described an IRA or 401k to you.
And that particular partner also has a gun.
Yeah.
Pointed at you.
That's
It's like,
right.
you have to go into that partnership if you want to do that,
Yeah, so let's go back to this 1997.
Right.
The government, when they're hard up for money, they come up with all these ideas. Now, this was a step in the right direction, but they didn't do it for us. They
Right.
did it for them.
Right.
Harry Roth says, well, let's tap into people's IRAs or 401ks sooner than when they retire. People are getting smart. Most people would rather just pay tax on the seed money, accumulate it tax-free, and then harvest the money tax-free.
Right.
And we'll name it after me, a Roth. And we'll get a windfall of revenue. See, these are revenuers. And we'll get a whole bunch of revenue because people will convert from regular IRAs, 401ks to Roths because they'll realize they're not going to be in a lower tax bracket.
Right.
Now, that may be smart. And so a Roth has two advantages. You actually pay tax on the seed, which I think is better.
Right.
And it accumulates tax-free. And when you retire, you take it out tax-free. Okay. And so it triggered a lot of tax revenue for the government, and that's why they did it. And then later on, they needed more, and so they came up with a Roth 401k. Now, Patrick, I've never owned an IRA or 401k or a Roth. I never will.
I want to make this real. So here you are a financial strategist. You give advice to very wealthy people, and you're saying, personally, you've never owned a Roth IRA, a traditional IRA, a 401k. Now, tell us why.
Because a lot of times what I own, which I call the laser fund, is called by CPAs and tax attorneys the rich man's Roth. And I snicker because you don't have to be rich to own one of these, but the rich can't own an IRA or 401k. They make too much money.
Right.
See, and so a Roth or a traditional, if you make too much money, you can't participate. They restrict how much you can contribute or a percent of your income. You can't touch it till age 59 and a half. You must start taking it out by age 70 and a half or it's a 50% penalty. All these strings are attached.
Right.
I don't like those. And so I have my own private rich man's Roth, so to speak. That's not what it's really called in the Internal Revenue Code. But there's no restriction on what I can put into my accounts. If I have a banner year, I could throw in 200, 300, 400 grand, because I have a lot of clients that do have windfalls, or they sell property or business or real estate or what have you. And if you don't have any money, you don't have to contribute it. If I put in money and a week later I have an emergency, I can pull out 70, 80, 90% of it. You can't do that with a Roth. And you don't have to wait 5 years or till you're 59 and a half. But the third benefit, besides having all that flexibility, because I have a beatitude, a personal, blessed are the flexible, for they shall not be bent out of shape. Okay?
Yes.
I don't want to be bent out of shape
Right.
when these topsy-turvy things happen in the world. But the third thing is, every $1 million that I have in my laser fund, if I died tomorrow, would blossom to $2.5 million instantly and transfer to my family bank. You don't know what that is, but I want to talk about it.
Good.
To my heirs, my wife, my kids, my grandkids, my charities. It 2.5 times itself instantly tax-free and transfers without a tax event. And a Roth will not do that. And I actually earn rates of return that are about 2% higher than normal Roths. I've been averaging 10.07% for the last 25 years tax-free.
Wow. So what is this fund then?
Okay. In the Internal Revenue Code, for over a century, since before the code, there's only one financial vehicle that allows a person to accumulate their money tax-free. You have to put in after-tax dollars. I help my clients get tax deductions indirectly, okay? That's another topic. And then you accumulate your money tax-free, and then when you take it out, you can take it out tax-free. You don't have to wait till you're 59 and a half. It doesn't matter if you're 100. It's tax-free, period, if you follow what the code says, okay? And 3, when you die, it increases in value instantly. It blossoms and transfers tax-free, okay? And that's not a municipal bond. It is deemed a maximum funded, tax-advantaged insurance contract. Most people, when they hear that, they go, what? I've never heard of that. I've never seen an insurance contract that has a decent rate of return. And I'm going, so you think they don't exist? Have you ever seen your brain before? How do you know that exists? I go, what kind of reason is that, you know? I go, actually, I have thousands of clients, and I've been doing this for 45 years. And in a nutshell, this was the brainchild of E.F. Hutton. I won't go into a long history, but Hutton, you know, they were selling stocks, bonds, mutual funds. But they realized that in the Internal Revenue Code was this magic instrument that allowed you to accumulate, access, and transfer money totally tax-free. And that was under insurance, because insurance was a sacred cow. In other words, you don't want to tax people who are putting money into something that's going to take pressure off of the government, welfare, and for widows and orphans and so forth. So if somebody wants to be responsible and accountable, and they want to insure themselves, let's say with life insurance,
Right.
they want to insure themselves for $1 million so that if I die, my widow that I leave behind and my kids won't be a drain on society and so forth. So why should we penalize people that are taking pressure off the government? They're taking ownership for their own future.
Right.
In fact, that's one of the things I teach. When you take ownership and take pressure off the government, you get tax benefits. That's why IRAs or 401ks are tax advantaged, because you're hopefully not going to rely on the government as much for your later years. Well, that's why this is tax-free. What Hutton realized is that most people, and they were the ones that were proponents, okay, you just buy insurance and invest the difference. It's like buy term insurance, invest the difference. And they were investing the difference in their stocks and bonds and mutual funds. But back at the time, if you earned 12%, did you ever play red light, green light when you were a child?
Sure.
Yeah, like Simon says. Okay. So let's say you're playing red light, green light, and you're in this mutual fund portfolio. And I had a Series 1 securities license. I had over 3,000 clients in mutual funds. They were never happier than when I got them out of the market and into these. So you play red light, green light. Some years in the market, you might make 20%. So you take 20 steps forward. Okay. And the next period, it loses 12%. So you take 12 steps back. And then 8 steps forward, and then so many steps back, and so forth. Well, what Hutton and these brokerage firms are trying to do is average a net of 12 positive steps forward. It's not happening. Right. But let's assume you could. You take 12 steps forward, but let's say you have that $1 million nest egg we were talking about. So if you're taking 12 steps forward, you're earning 12%. You don't get to keep all that money. You pull out 120 grand, and you got to take 4 steps back in tax.
Right.
You go 40,000 of tax. You take another step back in fees. You take 12 steps forward, 5 steps back every time you withdraw money for retirement. You're only netting 7% if you're lucky. The sad thing is Dalbar, who is an analyst of people's behavior in the stock market, they said if you just bought and held, like Warren Buffett suggests, you probably average 9.14%. You earn 90,000 on $1 million. You pull it out, you only net 60. Do you know what most investors average in the market in some of the most incredible periods like 1990 to 2000, when you could have thrown a dart at a dartboard made up of newspaper clippings of stocks and you would have earned 12.9? You know what most Americans earned in the market?
How much?
3.9. Because they were buying and selling at the wrong time.
Wow.
Emotion enters in. And the market starts to go down, and they hang on, and their advisor goes, hang in there. The market always comes back. And so finally, when it's about a 40% drop, they've lost it. And so they pull out, and they sell. And then they will not buy back in again until the market's back up here. So they're buying and selling at the wrong times, and so Dalbar says the average investor really earns about 3.49%. This is what precipitated what is called the 4% rule in the financial services industry. Have you ever heard of that?
No.
4% rule says this: if people's emotions involved only really is giving them about 3.5% return on the money, a fiduciary, a licensed advisor, is never supposed to recommend or illustrate a payout at retirement more than 4%. Without the client signing a waiver saying they will not sue you if they outlive their money. Because if you're earning 3.5 and you're pulling out 4, it's going to slowly deplete, but not before your LE. That's called the 4% rule. Patrick, on max-funded insurance contracts, I have earned over 45 years an average of 8.2%.
Wow.
The last 25 years, I've averaged 10.07 tax-free. Now, there's a cost, but it's not taxes. If I earn 10, I net 9. If I earn like last year, we're referring to the year 2017 was a heyday. I locked in gains of 25% on my max funded insurance portfolio, okay? On other 16. What do I mean by locked in? 2018 was sort of flat. I mean, many people lost. I didn't lose a dime. My clients never lost the 25% they locked in the year before, because your money's not in the market, it's linked to the market. It's called indexing. And so sometimes getting a zero rate of return is hero. So let me give you the worst decade since the Great Depression. 2000 to 2010. Let's even go to 2012. Here's why. Let's say you had $1 million nest egg in the year 2000. Okay. And you're thinking I can retire and take out maybe $75,000 a year, even though you only net $50,000 in a 33% bracket. What happened in 2001? 9/11. Now, from 2001 to 2003, people saw that nest egg they had taken their entire lifetime to accumulate drop from $1 million down to 600,000. They felt like they had lost their future. They had to put off retirement 7 years. It took 4 more years to make back that loss to $1 million to break even again in the year 2007. Then, in one single year, 2008, they lost 40% again for the second time in a decade. It took until 2012 to come back to break even to $1 million. We call it the lost decade. People that had max funded insurance contracts, my clients, they were almost cheering. Not because of the terrorist attacks at all. No, not because of that, but because when the market went down in 2008, they were going, go, 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 because they weren't losing. And you'll start making money again much faster after it bottoms out, because you'll start making money again here instead of losing. So you don't lose when the market goes down and you start making money again. What's the trade-off? A cap. The cap last year was 25%. If the market does more than 25, you only get up to 25. Or another one might be 16 or 12. So you have a cap on the most that you can earn, but you have a floor you will never lose. I mean, Patrick, I have not put a nickel in a slot machine in Vegas for 35 years. Well, let me ask you a question. If you walked into some casino and they said, Patrick, welcome. We're going to give you some chips here, and here's the deal. We have a special little guest table over here. We want you to have fun. So every day, as you play, you can keep up to 100% of all the money you make, up to a cap of 15% per day. Okay. But we do guarantee this, that if you lose, that you will walk out of this casino every day with what you walked in with. I'm not a gambler. I would
show up every day. Yeah, well, that's not gambling.
It's not gambling.
Yeah.
See, that's what I do for my clients. That's called indexing. Indexing is not a product. It's a strategy. The downside is you might not earn anything, but you won't lose.
But a cap at 25% is, is like no cap at all.
Yeah.
You know?
And not all of them. I have a diversified portfolio. Some have caps of 12, some 16, some 25. And that's where I have earned many, many years up to the cap. Other years I haven't, but the average has been 10.07. The cost of the insurance that the IRS says has to be there, or it won't be tax-free under the code, usually uses about 1%. But actually, this is strange. The older you get, the cheaper it becomes.
That seems counterintuitive.
Yep.
Yeah.
Yep. Do you want me to explain why?
It's because you're paying it along the way?
Yeah, because when E.F. Hutton came up with this idea, they realized that the multi-trillion-dollar insurance industry is not only the backbone of America, but the world, okay? In fact, one of the companies where I put my money, I'm very picky. There's over 2,000 legal reserve insurance companies in the United States. Legal reserve, these are the ones that through the Great Depression came through with flying colors when 40% of banks never opened their doors again. Some real estate dropped 80%. These insurance companies back in the Depression maybe continue to pay 2 or 3%. But, 2008, people don't know how serious of shape we were in this country. And so when the mortgage meltdown happened and all this, the federal government asked the 5 major banks in America to disclose where they had their Tier 1 assets. for liquidity and safety. Guess where they had 30 to 40% of their Tier 1 assets? This is money you have to have liquid on hand safe in the event of a run on the bank. BOLI, BOLI, bank-owned life insurance contracts. What? On who? Doesn't matter. They own insurance on their president, their board of directors, their stockholders. It's the owner of the insurance contract that gets all the tax-free accumulation and tax-free access. Now, if there's insurance, you want to put it on somebody close to you. So, my clients would put it on themselves or their spouse or their children. I have several of these. My wife does. I own them on my children. My children own them on me, which will knock the socks off of any IRA or 401k. Okay? I tell my kids or my wife, try to look down and look sad at my funeral, because you're going to be loaded. That's more of that. No, it's not about the death benefit, even though the death benefit is tax-free. It's because of the inside accumulation. So simply, Hutton said, instead of trying to get this much insurance, let's say, for the least amount of premium that pays off when you die, let's use this also, or even more so, as a living benefit. Let's take the least amount of insurance the IRS will let you get away with and put in the most money, and it turns into a cash cow.
And so basically you're overfunding the insurance policy.
You're way overfunding. People say, why would you do that? Because the insurance company then receives your money, and it's way more money than they need for your chance of dying. That's called the mortality cost.
Right.
And so you have all this cash in there in their general account portfolio. And it's just sitting there. And so what happens is when the insurance company goes out and puts your money to work, they are earning rates of return on AAA and AA bonds and mortgages on shopping malls and skyscrapers where they only loan about 50 or 60% loan to value. This is why there's never been a legal reserve insurance company ever not honor a legitimate claim, because not only do they have a lot of liquidity and safety, but they cross-insure each other. It's way better than FDIC, in my opinion.
Wow.
Okay? So that's why they weathered the Great Depression in 2008. So what you're doing, Hutton said, let's bypass the middleman. You put your money in there. Now, when this first came out, I had 3,000 clients in mutual funds. This was 1980. My clients were never happier because I got them out, and back then, for over 10 years, in their insurance contract, they were earning between 11 3/4 and 15.5%. Let's just use 11. So let's go back to red light, green light. They were walking 11 steps and only 1 step back. That wasn't tax. That was the cost of the insurance that the IRS said had to be there, or it would move from Section 72E and 7702 of the Internal Revenue Code, tax-free insurance, over to the investment part of the code that is taxable. To stay under the definition of tax-free insurance, you have to have a commensurate amount of insurance coming along for the ride. So if I had $500,000, and I had many clients back in 1980, they would drop in $500,000. They were earning 11, netting 10. So if they were retired, they could pull out 50 grand a year, tax-free. Pretty nice. And they've been doing it ever since. So they're earning 11 but netting 10. That 1% was paying for the insurance, but if they died, the 500,000 blossomed to $1.2 million. You know what's interesting, Patrick? We don't object to insurance benefits. I've never had a widower turn down an insurance. Oh, no, I don't want the check. No, we object to paying for it. So from what I've just said, if you're earning 11 and netting 10, and that 1% is paying for insurance that will take your $500,000 and blossom it to $1.25 million in this example, that wasn't a cost, that was a benefit. In other words, people say, Doug, how can you afford all that life insurance? I go, well, because I'm technically not paying for it. Uncle Sam's paying for it. What do you mean? Well, it's being paid for with otherwise payable income tax. To net 10% after tax, I would have to earn 15 or 16% in my tax bracket in a mutual fund portfolio to net 10. Earn 15, net 10, because a third of it belongs to Uncle Sam. I can more conservatively, more predictably earn 11 and net 10 in the insurance contract because they don't mess around with my money in the stock market.
And I'm saying you're not at risk like you would be
I'm not at risk.
any others. Yeah.
Because what's happening, I mentioned indexing. So every year I have the choice. If I leave my money in the insurance company that I've overfunded, And most insurance companies have had a general account portfolio yield the last few years of about 5%. Okay. It's because of the lower rates on mortgages and what have you. Now, I can just choose anytime I want, just pay me the 5%. Mm-hmm. And that's fine. So on $1 million, they would credit me 50 grand. That's what I would do if I felt bearish about America this year. Mm-hmm. But if I feel bullish, mm-hmm. I go, okay, I think the economy is going to grow more than 5%. So you can opt to link some or all of, let's say I have $1 million in there. Mm-hmm. I can link some or all of that million to an index or indices of my choice. Mm-hmm. The 6 companies where I put my money, and by the way, one of them manages $2.5 trillion. You know how much money that is?
A lot of money.
That's as much as the IRS collects in income taxes in a single year.
Right.
One insurance company, okay?
Wow.
They're pretty big.
Yeah.
Now, that money that I link over there, then they offer different indexes. Let's say the S&P 500 or the Dow Jones or the Russell 2000, or they have an exclusive on what is called the BUDB, the Barclays U.S. Dynamic Balance Index. So what they do is they say, oh, so you're relinquishing the for sure 5%. Yep. You can do whatever you want with that 50 grand that you're earning on my $1 million this year. Mm-hmm. But don't put my $1 million principal at risk. That must stay safe in your insurance company. Okay, what do they do with the 50,000? They buy upside options in the S&P or the Dow Jones or whatever. It's very simple. They're the number one purchaser of options in the world, which means this. If the S&P was up 10%, then it's very easy for them to pay me 10% instead of 5%, 100 grand instead of 50 grand, because the options matured.
Right.
If it goes up 15, it's very easy for that 50,000 to triple to 150. But they have to cap it based upon the price of options at maybe 15 or 16 or 20 or 25%. The trade-off is, if the economy tanks like 2008, and everybody else in America that had their money in the market, their $1 million would have dropped to 600,000. I didn't lose a dime. Because I relinquished the 50. The options expired worthless.
Right. I was going to say, you just don't exercise the option. You're at zero.
Yeah, I end up with my $1 million, but I didn't lose. See, sometimes zero is hero.
Right.
When you do that, and if you study the market, I know that most of the time, 70% of the time, the market's going to be up, okay? And only 30% of the time, the market's going to be down, and I will always earn 2 to 4% more than the general account portfolio rate that the insurance company is earning. Banks do this. Patrick, I'm writing a book called How Money Really Works. We put our money in a bank, and they were only paying us like 1%. So you can do 4 things with money. You can spend it, lend it, own with it, or give it away. So when money is at a bank, credit union, or an insurance company, it's in a lended position. Does that make sense?
Yes.
Okay. Why are they borrowing our money and paying us interest? Are they just a benevolent institution? No. What are they doing with our money? They're borrowing our money, $1 million, and paying us 10 grand. Now, in 2008, they disclosed right off the bat, they're taking 30 to 40% of their Tier 1 assets, and they're turning around with that money, and guess where they're putting it? Right where I just told you.
Right.
In the insurance company. Because the insurance companies are usually rated AAA. The ones I put my money in. A lot of banks are only rated BBB. So they borrow our money at 1%, put it into an institution ranked 6 notches higher in safety, and they're earning 5%. How much more is 5 than 1?
4.
No, it's 500%.
How so?
Would you hire an employee for $10,000 that made you an extra $50,000?
Sure.
That's called a 500% return on employment cost if you're a business owner. Would you buy a widget machine for 10 grand if that widget machine made you an extra 50 grand?
Of course.
It's 500%, not 4%.
Wow.
You get it?
Yes.
And they're doing it on OPM, other people's money. All I tell my clients is you can bypass the middleman. You can take your money, increase the liquidity and the safety and the rate of return, and you could be earning 10 tax-free.
So this is then the real business of the banks, is what you're saying. You know, not making money on mortgages and some loans or what other things they might do, which is a part of their, but really their biggest business is what you're describing.
Patrick, the banks could do far better if they did not loan one dime to the public. But they can't get away with doing that, or people would stop bringing money to deposit it into the bank. But the bank can more predictably and safely borrow our money and put it into these types of instruments, but it's also the velocity of money. So I often ask my audiences, why in the world would a bank or credit union who can borrow our money at 1% and they can turn around and earn 5 times that, tax-free, ever want to loan you or me $1 million to go buy a home or something like that? And people go, well, because they have to? No, there's no regulation that says they have to. I mean, if we didn't give them the money, maybe we would stop doing that, but that's not the reason. So if I go to a bank and I borrow $1 million to go build a house, what am I going to do with the million? I'm going to give it to the general contractor. What's the general contractor going to do? Take his piece, pay his subs, and the suppliers. What are all of them now going to do? Loan that $1 million back to the bank again. It goes right back into the banks. The banks get it back in a week or so at 1% or less if it's a checking account. They get it back again and they loan it back out again at 500%. The average bank will loan out and receive back, okay? They'll do that 17 times. They'll turn over the same money 17 times a year, only 12 times a year in a recession. Shucky darn. So see, they can afford to take risks that if I lose my job and they have to foreclose, they don't want to foreclose on my house, but they've calculated that in there. But if they can borrow OPM, other people's money at 1% and loan it back out again at 5%, at 5 times, 17 times a year on the same money, that's called the velocity of money.
Wow. So this really starts to sound like a racket.
It's called the banking industry, but it's not new. This is the parable of the talents in Matthew 25 in the New Testament. This has been around for millennia.
Wow. So you illustrated so well as far as the analogies that you weave into it, so that it's something tangible to us lay people, that go out and work every day and not see this this sort of look behind the curtain.
Yeah.
So so when you start to look at, okay, so we got banks, we got the government, and we see how literally, I don't know that I'm going to say it's totally malevolent, but it seems like it's rigged against producers, right? That the system is, that these people are locked in and they enslave the producers in the ways that they, with inflation, with taxes, et cetera, with the relending of your money. Because if I buy, like you said, if I borrow the money and I go build the house and something happens to me, I'm at risk. Then next thing you know, maybe I'm bankrupted in the house, but they don't care because that money is trickled back to them over and over again. 17 times.
Yeah.
So where could I get into that business, right?
Well, in a lot of my books, I talk about how to become your own banker.
Right.
Okay. I'll give you a little taste. For example, in my max-funded insurance contracts, let me use an example of an actual friend, a client of mine who is a real estate developer. Okay. What he does is he buys strip malls, large apartment complexes that people want out of. He will fix them up and then flip them to somebody. He doesn't like to keep them and be a landlord.
Right.
So he has a pool of investors looking for fixed up properties, and he goes out and finds the distressed properties. So where he keeps his working capital is where I do in my insurance contracts, because it's very liquid. You can access your money with an electronic funds transfer or phone call. Okay. So many times he might call and he'll say, Doug, I need $1 million out of my insurance contract to tie up an earnest money agreement on a $30 million project I want to buy. I go, great. How soon do you need it? And if it's a week or so, we can just do it normal. But he says, I need it tomorrow. In the insurance contract, he can get that electronically. We can overnight it or whatever. Now, he says, send me the form. It's 1 page. He puts his name. He puts his account number or policy number at the top. He's going to sign it on the bottom. He doesn't have to have his signature notarized unless it's going to a different bank account or address than on record. And the one sentence, the one question that he must answer is, do you want to withdraw $1 million out of your insurance contract, or would you like to borrow $1 million? Guess which box he checks? Borrow. That's right.
Yeah.
Here's why. If he withdrew the $1 million, the million that is, and he's been averaging about 10% like me. So if he withdrew it to do this and he didn't pay it back for a year, he would relinquish $100,000 of interest on 10 grand on that million.
Right.
He doesn't have to do that.
So he keeps the full principal balance for his rate of return, and yet still has access to capital to be able to do his
Yeah, in other
entrepreneurial
words,
project.
let's say you went to a bank to borrow money and they said, well, you have a savings, a CD here. You can use that as collateral and we'll loan you the money. But see, the banks will loan you at 5 and they'll only pay you 1.
Right.
No, this is different. With the insurance contract, the insurance company says, oh, heavens, yeah, we'll loan you the equivalent of your cash value in here. And so you'll just leave it here and we'll keep crediting you with this indexed return. And we'll loan you $1 million. They guarantee to never charge you more than 5% with this particular company that he has.
And he's making 10% on it.
He's pulling it out. He doesn't have to write out a check to pay the interest. The insurance company charges 50 grand at the end of the year, and they credited him 100. He made a net of 50 grand. He made a net of 5% tax-free on his money while he was using it on top of what he was doing.
So is this the best kept secret in the financial world?
Oh, yeah.
I mean, you know, is
Well,
that what it was?
you were asking, how can the little guy do it?
Right.
Last year, he borrowed at 5% and earned 25% on the money that he borrowed because he didn't actually withdraw it. So he was earning 25, it only cost him 5. So he netted 20% tax-free on his money while he was buying real estate.
So it's literal when you say be your own bank. You get to be in the business yourself of banking your own money rather than using these banks, which are just
You
pillaging.
can do this to buy cars or anything or
Yeah.
businesses. This is where I have my working capital for my business. And so, yeah, a lot of people don't know what they don't know, and this is why I write the books, and sometimes it goes over people's heads, and even financial advisors don't get it. But the message here is, Patrick, it's really understanding how money works, and the 3 marvels or miracles, compound interest, tax-free accumulation, not tax-deferred.
Right.
It was Einstein that said compound interest is the 8th wonder of the world.
Right.
It was Rothschilds that said, no, compound interest, tax-free. Do you know if you double a dollar doubled 20 times is $1 million if it's tax-free. If it's taxes earned in a bank or credit union, in a 25% tax bracket, it's only worth $72,000.
From $1 million to $72,000 is the impact of taxes. Wow.
In other words, a dollar doubles to $2. Now you pay tax of 25 cents on that gain. So you only have $1.75.
Right.
The $1.75 doubles to $3.50. You pay tax on that. In a 25% bracket, you don't have $1 million. You only have 72 grand. Wow. In a 33% bracket, you only have 27,000. When you could have had $1 million.
Wow.
So to summarize, where do most people in America put their money? Taxed as earned investments. They put it in banks and credit unions. They could have $1 million and they only have 27,000, for example. That's like crawling around a racetrack. We're going on $1 million dash here and they're crawling. If you put it in a tax-deferred IRA, oh, it's tax-deferred, I got $1 million. No, that's not all your money. Only about 650,000 of that is your money. Why don't you sprint around that track, put it in something tax-free, okay? Double it in that 20 times, you have $1 million and it's tax-free, and that'll generate 100 grand a year of tax-free income into perpetuity. And you can put that in your family bank, and you let your children and grandchildren access that money with responsibility and accountability with some skin in the game, and you'll never run out of money.
Doug, I feel like I could do an entire docuseries on you. Seriously. I mean, it seems like there's a lot of places that we can go explore, but I think the view you've given is something that should be an awakening, which is really the essential purpose in this particular process, this docuseries, is to say that there's so much that we don't understand about money. And what we don't understand doesn't just impact us monetarily, it impacts us spiritually, and it impacts our entire human experience here. And it can create great suffering, or it can be great joy if you know what you're doing. I mean, the humanistic side of this is immeasurable. So, but you've now just laid out literally what the predicament is and what the solutions are. And all I can say is I'm going to go out and read all your books when we're done here. I'm going to encourage others to do the same. And I just very much appreciate you taking your time to share all this with us.
Thank you, Patrick. It's been an honor.
Does Robert Kiyosaki really need an introduction? Probably not, but I will anyway. When I was sitting with Robert Kiyosaki, you just have this whole aura that comes out. This man is smart, insightful, focused, and very, very passionate. So many people that I interviewed for this series talked about Robert Kiyosaki's influence on them. He is a man that has helped develop wealth in countless people's lives, and I want him to do that for you right now. So lean into this interview that I have with Robert Kiyosaki. Robert, I'm really excited to have this conversation with you, so thanks for being here.
Hey, thank you. I'm excited too.
I feel like we could talk for days about so many things, as far as the wisdom that you've generated over the years relative to money and investment and what's wrong with the system and how to change your perspective of it. So what got you started on the road to being an entrepreneur?
I just didn't want a job. I mean, I just didn't want a job. Every time my school teacher says, if you don't get good grades, you won't get a job. I said, good, I'm on the right track, because I never had good grades. And that drives a lot of people crazy because education is very important. Mm-hmm. But for me, going to school was a waste of time because I had a rich dad and I had a poor dad. And my poor dad was the head of education. Mm-hmm. And he was poor because he was in education. And so I knew my dad was a PhD, from Stanford, University of Chicago, Northwestern, head of education for the state of Hawaii. And having him as a father, I realized that if he went to school, he'd probably never be rich. So at the age of 9, I raised my hand I was in the 4th grade growing up in Hawaii, Hilo, Hawaii, a little sugar plantation town. Mm-hmm. And I asked my 4th grade teacher, I said, when will I learn about money? And she looked at me, she was like a church lady, like Dana Carvey, and aren't we? She goes, we don't teach money at school. So I asked her, so why am I in school then? And I kept bugging her. And finally, and she was like 10 years over retirement, I think. And she got nastier and meaner at me because I was 9 years old. My classmates were all rich and I was poor. And I'm going, I just want to be rich. I don't want to go to school. And she said to me, the love of money is the root of all evil. Mm-hmm. I looked at her, I said, well, how come my classmates are rich? They're not evil, you know what I mean? And the hypocrisy got to me, how kids are at 9.
Sure.
And so I went home to my poor dad, the head of education, PhD, all that stuff. And I said, how come they don't teach us about money at school? And he says, because the government doesn't allow us to do that. And I said, Dad, that's really strange that they don't teach money at school. He says, what do they teach us to do? He says, get a job, be an employee. Mm-hmm. But I said, isn't that to work for money? He goes, well, yeah, I don't want to do that. I don't want a job, and I don't want to spend life working for money. It's a slave to money. Mm-hmm. So finally he said, well, why don't you ask your classmate, your best friend in school in the 4th grade, because his father's going to be a rich man someday. So how do you know that? He says, because Mike, my rich dad's son, is an entrepreneur. And I went, what's an entrepreneur? He says, somebody doesn't need a job. I said, I want that job. I don't want a job, and entrepreneurs create jobs. Mm-hmm. So that's how I kind of got started, just by asking what my 4th grade teacher thought were stupid questions. And that changed the direction of my life. So at the age of 9, I began studying with my rich dad, a man who never went to school. Mm-hmm. His father died when he was 13, so he took over the family business. And in retrospect, what made him smart, his teachers were his accountants, his attorneys, his bankers, mm-hmm. his real estate agents, because he was 13 years old. And he had real teachers. What I mean by a real teacher is somebody who's actually doing the real thing in real life. Mm-hmm. And as you know, most school teachers don't do the real thing that they teach.
Right.
And by the time I got to the college, I went to academy, and I was flunking out of school for calculus, 3 years of calculus, and I couldn't do a damn thing. Mm-hmm. And I asked my calculus teacher, I said, when are we going to learn about, why am I studying calculus? He goes, I don't know. And I asked him, I said, do you ever use calculus? He goes, no. I said, why do you teach it? He goes, because I get paid to. And I'm a child of the 60s. If I flunked out of calculus, it was nonstop to Vietnam. Do you know what I mean? So
yeah.
I had an incentive to pass calculus, which I flunked anyway. But anyway, that's where I kind of got disillusioned with school, education. Education's important. But my poor dad was a poor man, although a PhD, because they don't learn anything about money, and they don't teach anything about money in school. And so we wonder why today we have a rise in socialism and communism and fascism and the anger against the rich. These young senators and congressmen, they want to tax the rich and charge them 70% taxes and all this. And I'm going, why are they doing this? Well, it's because our schools don't teach us about money. And that's why I'm in this business.
And it hasn't changed since you were in school. I mean, today it still seems to be the same.
No, it was not going to change. It's really, it's tragic. So when I ask people, I said, what does school teach you about money? Get this zzz. And I said, does your teacher know anything about money? They go, zzz. Do our political leaders know anything about money? Zzz. There's this, like money is the root of all evil in many people's minds.
Yeah.
But we all use money. That's the irony of it.
Is there a relationship between the banking systems, I'd like you to comment on the banking system, and the educational system?
Well, the banks run the world. It's called the central banks of America. The Fed, the ECB, the European Central Bank, the PBOC, People's Bank of China, the Bank of Japan. Capitalism is run by a central banking system. That's called communism also. The government is, communism is centralized government, capitalism is centralized banking. And the more you step back, you look at the big picture, the ultra-rich control the central banks. For example, the Rothschild Corporation, let's say there's 50 central banks, the Rothschilds own about 48 of them.
Wow.
And so you and I don't have a prayer because money makes the world go round. And the economy runs on money, like it or not. So that's why I became a student of money back in the 80s. And I began looking at, I was a student of R. Buckminster Fuller, a guy who created the geodesic domes and all that. And he wrote a book called Grunch of Giants. Grunch stands for Gross Universal Cash Heist. It's how the ultra-rich steal our wealth. And so when I read Grunch of Giants in '83, I understood what my rich dad was telling me. And that's when my rich dad, he read Rich Dad, Poor Dad, it says the rich don't work for money because our money is toxic, our money is corrupt. Our financial system, or money, is designed to make the rich richer, but keep the poor middle class poorer. And that's why our schools don't teach us about money, because the school system works for the central banks also.
So basically the schools are designed to create
Employees.
employees, an employee mindset.
Correct.
Which is, I guess, in a part survival mindset. You get a job just to provide for your
To work for
family.
money.
Yeah. And
But you learn nothing about money.
right.
Ironic, isn't it?
It's well, look what would happen if you enlightened them about money in school. They wouldn't get out and go work for the bankers.
I don't know. I don't know what would happen. But I think the house of cards is about to come down anyway, because the corruption inside our banking system is at all-time highs. This has happened before in history. It's been going on for thousands of years where the banking system, I'm not blaming bankers. I like my banker a lot because he gives me money. But anyway, the whole system was rigged by the banks, the golden rule. He who controls the gold makes the rules. And so I decided I'd rather be on the banker side than the employee side. It's just a choice.
Yeah. So when you came to that realization, then real estate seems to be your central focus for your investment.
Not really. Okay. People think I'm a real estate guy. I am an entrepreneur. I have many, many different companies. I create jobs. I don't have a job. I don't have an office. I'm not allowed in my own company. See, an entrepreneur is just a free person. That's all it is. You don't ever need money again.
And yet you're, as you said, providing jobs and you get into these industries. So maybe we talk about the varying activities, but can we start with real estate and talk about your views of real estate investment?
Well, it's really a business model. You know, everybody talks about the business. You know, I came and asked you about your business model because every entrepreneur has a different business model. So the model I followed was McDonald's. You know, Ray Kroc. If you read Rich Dad Poor Dad, in there, my friend interviewed Ray Kroc. You know, he was in the MBA program at University of Texas, and Ray Kroc asked the class, the MBA class, he said, "What business is McDonald's in?" And everybody says, "You're in hamburgers." And Ray laughed. He says, "No. McDonald's is in the real estate business." And so and there was a movie called Founder.
Yes.
With, I think Keaton
Michael
started
Keaton.
that. Yeah.
Yeah.
And in there, he spells it out. The only reason you create a business is to buy real estate. Now, people think, oh, you're a real estate guy. No, that's not true either. So my business, so I have Rich Dad, let's say, and I buy probably $500 million worth of real estate on one company. And the reason I can do that is because real estate is really about debt and taxes, which they never teach you in school. So you understand, the more profits I make, let's say I make $1 million in Rich Dad, I can lever up, I can borrow $5 million to buy a piece of real estate. So I'm using debt to get richer. Most people use debt to get poor, but that takes financial education or literacy, whatever you want to call it. So I buy real estate, and because I have $5 million in real estate, I pay no taxes. So the real game is called debt and taxes. That's why if you read Rich Dad, Poor Dad, the rich don't work for money. I don't have REITs, I don't have ETFs, I don't have mutual funds, I don't have stocks, because I'm an entrepreneur.
So how is it that debt, real estate debt, because a lot of people, you hear them, just prattling about debt is bad, never have debt, you don't want to get into debt, et cetera. You're advocating it and for tax savings, I guess in part for tax savings. So how does that work?
I didn't say tax savings, I said don't pay taxes.
Oh, well, okay, so to eliminate taxes.
Big difference.
Yeah, okay. So
that drives people crazy.
Yeah.
How can you not pay taxes? Well, you have to understand tax law. Okay.
Can you speak to that?
Yeah, tax laws are not about not paying taxes. Tax law is incentives. So the government wants you to do certain things. For example, if you donate to a church, they'll give you a tax break. You donate your car to the Kidney Foundation, they'll give you a tax break, right? So if I buy real estate, give me a tax break. Lovely stuff, because I'm providing housing. If I invest in oil wells, I get a tax break because the government wants energy. If I invest in food production, I get a tax break. And when I borrow $5 million to buy a piece of property, I get a tax break because the government needs me to be in debt. You see, if there's no debt, the economy collapses. The reason, when they dropped the interest rates after that whole central bank, the Fed screw up, they had to drop the interest rate so guys like me would borrow. If they didn't want me to borrow, they'd raise interest rates. So they want me to borrow. When I borrow money, I create money. See, money is only created as debt, bonds. As people don't understand, they don't teach this in school. So the more I borrow, the happier the government gets because I'm actually putting money into the economy. So I borrow, let's say, $5 million. I buy a $5 million piece of property. Then the tax law allows me to appreciate it, depreciate it, and amortize it. Zero taxes. I collect all the income from that property tax-free. That's the game.
Is there ever a day like in the future that comes home to roost, or is it something that you can perpetuate year over year over year?
Yeah. But you've got to be smart. They'll never teach you this in school. I don't know her name, Elizabeth Warren and Kamala Harris and AOC, they're all saying, let's tax the rich. So if you're over $10 million income, they're going to tax you 70%. Let me wake people up here. You're making $10 million a year. You're not paying any taxes because you can hire the best tax accountants and tax attorneys that the money can buy. So they never tax the rich. They tax the stupid, the uneducated, the misinformed. And it's tragic, and that's why I wrote Rich Dad, Poor Dad. The rich don't pay taxes legally because the government wants us to do certain things. They're incentives. So when I buy an apartment house, I'm providing housing. I get full tax breaks. When I drill for oil, I don't buy Standard Oil or Chevron or Exxon. If I drill for oil, the day I drill for oil, I get a 70% tax break. The day I drill, day one. Let me say this again. The tax code is not about paying taxes. The tax code is a series of incentives. Say, if you donate to your church, we'll give you a tax break. You grow food, we'll give you a tax break. You produce water, we'll give you a tax break. You provide oil, we'll give you a tax break. You provide real estate, we'll give you a tax break. So if you're paying taxes, you're not helping the government.
Right.
It's a different point of view, that's all I'm saying.
I've always felt and maintained that taxes were more about controlling behavior than they were about collecting revenue, right?
It is.
It's like saying, hey, if you don't do these things, you get punished.
Yes.
If you do them, you get rewarded.
Yes.
Yeah, it's really that simple, isn't it?
Tax code, my accountant, Tom Wheelwright, the smartest guy I know, he wrote a book called Tax-Free Wealth. It's a Rich Dad Advisor book. If you're sick and tired of paying taxes, get the book. It's called Tax-Free Wealth by Tom Wheelwright, CPA. He's the guy that guides me.
Well, so, and this is where I've always personally felt the pain. I've been an entrepreneur for decades now, generated a lot of income. And what I came to realize after a couple of decades of working nights, working weekends, launching businesses, doing startups, taking risks, doing all the things that entrepreneurs do, is that if you do that and you make regular income doing it, by the time you pay taxes, live any kind of a reasonable lifestyle, put your kids through school, you can't accumulate any real wealth.
No,
it's
you're
impossible. Taxes just deplete the ability to have wealth accumulation.
And I'll give you even worse advice.
Yeah.
Worse, I hate to break the bad news to you. You know, so many young people, I'm going to be an entrepreneur, or I'm going to quit my job and become an entrepreneur. The moment you quit your job, become an entrepreneur, you pay higher taxes.
Yeah.
You see, an employee will pay approximately 40%. This is all over the world. Employees pay approximately 40% of their income in taxes. Small entrepreneurs pay 65%. You can't get ahead that way.
No.
So Rich Dad is a company. We educate people about the big business side, the McDonald's side. You know, as Ray Kroc said, my business is real estate. So when I come in here, I'm looking at all your equipment and all this stuff. So this is depreciated at, pretty good rates.
Right.
But if you want long-term, not pay taxes, it's real estate.
Well, so you're starting my story. So I'm going to ask you, be my rich dad for a minute. And so if I'm a guy, and I am, that makes pretty high above average income,
You pay high above taxes.
I
too.
pay a lot of taxes, and it's always, when you're making that kind of money, you can afford to pay more taxes. And I'm like, but why do I get punished for the more I produce, the more I'm punished? Which means that I can't produce as many jobs, I can't expand my business, I can't, all those things. And if you take the people who value create and punish them, and take the people who don't create and reward them, it doesn't take long to see where that might end. So I've logically worked all that out, but I've said, but what is the pivot point? How do I now go from this and say, I have some income, and I think I'm speaking for a lot of people who are watching this. I have some income. I maybe even have some accumulated capital. But how do I now, what are my steps to saying I want to move toward that rich dad mentality and find a way to eliminate my tax burden and actually accumulate some wealth?
Well, that's why I said education is really important. If you do what they tell you in school, like doctors and lawyers, they pay the highest tax rates around.
Exactly.
That's not that intelligent, and they're the A students.
Yeah.
The C and D students like me, we don't pay taxes, but we hire good accountants, good attorneys, and we do what the tax code wants us to do. So, when the markets crashed in 2007, I thought I died and went to heaven because, they were giving real estate away and the interest rates dropped. Holy mackerel. I thought, thank you, Jesus, you've given me, so I borrowed $300 million. And I bought all this real estate they're giving away, and I depreciated it. I appreciated it and amortized it. So I made millions and paid no taxes on debt. I borrowed money. But that's what I'm trained to do. I'm not trained as a lawyer. I'm not trained as an accountant. I'm not trained as a doctor. Thank God. But I did have a rich dad. He's a man who never went to school. But he was trained by his accountants, his attorneys, his bankers, and all that, real teachers, not these fake teachers in college.
In part, if you're not looking to become a professional that requires a certain educational process, do you think that college education or quote unquote investing in tuition is probably not a good investment?
It depends on what you want to become. You want to be a doctor? I should hope you go to med school. And all Rich Dad Company did was give people a choice. Say, you want to be an employee or a specialist like a doctor or a lawyer, go to school. You want to be rich like what do you call Zuckerberg or a Jobs and be like a Buffett or a Soros, Rich Dad. Mm-hmm. We're the 5%. And that's all we cater to. Yeah. And we're not very popular with the school teachers.
You've got that right for sure.
Correct.
Yeah.
That's my poor dad. They're good people. Don't get me wrong, I'm just saying these are your choices here. And freedom is about choice. But we're not given those choices in school.
Well, what's interesting, because I think to me in the end, because you talk about, like you said, your dad, skilled academic, right? And
brilliant.
And probably a beautiful soul and caring and et cetera,
yes.
Has a purpose in life and wants to leave the world a better place. So the intentions are all proper, but there's also, I think, in that academic sector, this sort of disdain for the quote-unquote profiteers, the entrepreneurs. Entrepreneur was almost a bad word when I went to school.
It's still a bad word.
Yeah. So it starts to, I think, translate, at least for me, that this starts to become sort of this spiritual issue, right? That I believe that, for the people who were indoctrinated in the system, get out and they're working and they're taxed and they're, all these things go on, that I think it has some sort of adverse impact on the human spirit. It's not just a monetary issue.
Correct. There's 4 different types of intelligences. Number 1 is mental, and that's the academic type. 2 is physical, those are the athletes. Mm-hmm. 3 is the emotional, and 4 is spiritual. Mm-hmm. And they're all different intelligences. So the combination of those 4 makes up the human being. So for me, what gives me the advantage is emotional intelligence. See, most people come out of school so terrified of making mistakes. They go, oh, what if I fail? I said, well, if you're not failing, you're not learning it. Oh, what if I fail? In school you make mistakes, you're stupid. In school I was very cooperative at test time, but that's called cheating. You know what I mean? Everything is opposite. It's like we're like a parallel universe. E's and S's on one side, B's and I's on the other. Right. And all the Rich Dad Company does say, hey, look, you want to be E's and S's, go to school. You want to be on the right side, the B and I side, the big business, 500 employees or more. I have thousands of employees. Mm-hmm. I provide a lot of jobs, so I pay no taxes. I should get that.
Right.
I don't like it when I see people struggling financially. I don't like this gap between the rich and everybody else. I went past the 1% long time ago. Mm-hmm. I'll give you an example. In the 60s, I'm a child of the Vietnam era guy. I fought in Vietnam, I'm a Marine, I'm a pilot, and all this stuff. Mm-hmm. But I fought for capitalism. Mm-hmm. I really did. I sincerely believe that in the American dream. But when I was in Vietnam, there wasn't much of a gap between rich, poor, and middle class. The rich had nicer houses and newer cars. That's about it. Poor guys had junk cars and junk houses. That's about it, though. Mm-hmm. And then it got to be that as capitalism took off and provided things. So today, the poor and middle class, they can afford to travel throughout the world, but they fly on Southwest or discount airlines. Mm-hmm. So capitalism provided discount travel for the poor and middle class, but the rich fly private jets. Mm-hmm. Today, the rich have their own rockets and their own satellites. So, do you know what I mean? Guys like Musk provides it. Branson has his own satellites and all this. So I'm going to have my own rocket ship. I just don't have it yet. Mm-hmm. And that's the beauty of capitalism. Yeah. For me to have my own rocket ship and launch my own satellite, I better be doing something.
Yeah.
Now, it's a stupid goal. I don't recommend it. But that's what capitalism is. Whereas socialism, let's take from the rich and give to the poor. Right. It's called Robin Hood theory. Mm-hmm. I don't support that because when I was in Sunday school, I was taught to teach people to fish, not take from the rich and give them fish.
Right.
And so that's where we separate. It's sad to say.
What do you think, if you look into the future, this wealth gap that you're seeing that's starting to widen, where's this going to lead us?
I think we're going to economic collapse, personally, because We've done for thousands of years what we're doing today. We spend too much money, we print money, we debase our currency. During the Roman empires, they took gold and silver and they mixed it with lead and nickel and stuff like this. We're doing the same thing. And so the trouble with what's happening to our money is in 1971, when Nixon took us off the gold standard, the dollar became debt. People don't know that. Dollar is debt. And they could print as much as they wanted. So the value of the dollar goes down. So if you're a rich dad, poor dad, I said savers are losers. Because why would you save it when the Fed can print it? It doesn't compute in my capitalistic mind. The trouble is, historically, for thousands of years, anybody who's done this collapses. So the Roman Empire collapsed, the Chinese government collapsed, and we're doing the same thing. We just don't live long enough to know it. So we're pretty close right now. We just can't keep printing money and giving people money for free and think that it'll survive. And the trouble is, it's now a global problem. We have the central banks of like European, Japanese, Chinese, everybody's central banks today, and we're printing money. It's not going to last.
This is a somewhat poignant statement. Savers are losers because they're saving dollars or whatever their currency is, and
that's all they know.
Yeah, and it's all they know. And incidentally, it's promulgated, right? You need to save, have zero debt, and you need to save, and that's the way you get to your future.
And I have 100% debt and no savings. It's opposite. It's a parallel universe.
Wow. But clearly, based on what is happening, how money is debased, it's clearly you're a lemming walking off a cliff.
Yeah.
And then you end up pretty broke, and you've got more life in front of you. And then what's going to happen is the communists are all going to scream more that we have to take from the rich and give to the poor.
Correct.
Scary scenario.
And the rich are screwing everybody. It's not the rich, it's our education system screwing everybody. That's the problem. See, I'm a child of the 60s. I remember this quarter came up and had a copper tinge around it.
I remember this.
1964.
Yeah.
That was debasing the money. And that's when savers became losers. Yeah. So I was at a antique show, and they were actually selling quarters for $5 because the silver value was worth $5 now.
Wow.
And so if you're a saver, you go, well, why is that quarter of $5 now? Because your savings have gone down in value. No, they wouldn't do that to me. I said, yeah, they do every day. They print it.
Wow.
They print money to pay their bills. If you and I did that, we'd be in handcuffs.
True.
Yeah.
No, I think that's really a great analogy, saying, okay, here's a silver quarter.
$5.
I get $5 for that. Here's one of those ones with the copper rim.
Yeah.
It's 25 cents.
Yeah.
And that's the difference between saying we have a monetary system that's based on something that's attached to like silver or gold, as compared to saying we just can do what we want to the currency. It's got no reference point, and that makes it worth less and less every single day.
Yeah, and everybody watches the stock market. Being a professional investor, the problem's in the bond market, and the bond market is bigger than the stock market. So we're in serious trouble financially, and so that's why when I talk to people, I say buy a silver dollar. It costs you $20. Oh, I can't afford $20. I said, then you got trouble.
Yeah.
Buy a dime for $2. I can't afford $2. It's the mindset screwed up. But they can go to McDonald's and buy a Big Mac.
Yeah. And then hope that the consequences of the Big Mac on their health is going to be paid for by the government.
And then they'll buy real estate with that Big Mac. And pay no taxes and use debt to buy it. That's why the rich really get richer.
And in a sense, you say personally you pay no taxes, but you have...
I do it because I do what the government wants me to do.
Exactly. And at the same time, though, you're causing, through the jobs you create, many workers to pay a bunch of tax. So
Amen.
There you have it, right?
They love me.
They have to love you because the people who are indoctrinated into the system, who go to work for somebody else to pay their taxes every single
Go to school,
paycheck.
get a job, and pay your taxes, save money, get out of debt, and invest in the stock market.
And if there's not somebody like you to orchestrate what needs to happen for those workforces to have a job, then there's no taxes that happen. So you're right. You're heroic to the tax collectors because you create the jobs of the people that can be
Pay
taxed.
taxes.
Yeah.
Yes. You got it.
Yeah. Oh, yeah. I got it. And
It's the system.
So what would happen if you did a thought experiment? What would happen if tomorrow morning the workers woke up to all this, kind of saw it for what it was? Suddenly, let's say that they can do a matrix download, and they suddenly say, "Oh, I just got the rich dad education, that I never got." Does that transform things in a positive way? What happens?
Well, it'll never happen. Like I said, there's 4 types of intelligence. There's
Yes.
mental, emotional, spiritual, physical. And most people, when it comes to money, they're emotional as hell. They can't help but spend money.
Yeah.
They go to work to spend money. And the difference between, there's small entrepreneurs and big entrepreneurs.
Right.
My job as an entrepreneur is to create assets. That's all. So when I started the Rich Dad Company. It's an asset. I never worked there. Mm-hmm. I get a lot of money all the time from that. I buy real estate. I get money all the time. Then I buy oil wells. I have money all the time. And assets put money in your pocket. The reason the poor and middle class struggle is they buy liabilities they think are assets. Let me give you an example. You ask the average person, a house is an asset. Your house is a liability.
Because it's not producing any income.
Correct. It's taking money.
Wow.
And not only that, Rich Dad, Poor Dad, so what's the secret to it? It's a book on accounting. That's all it is. A simple book on accounting. And they never teach you accounting in school.
Elaborate on that. So when you say it's a book on accounting,
Income, expense, asset, liability, statement of cash flow.
it's a,
Very simple stuff.
yeah.
You can teach it to a kid. But our schools will not teach it. I tried. I took it to Harvard and I got kicked out. The European system of education produces 2 types of people, employees and soldiers, people who will do as they're told.
Yeah.
They cannot think.
Chilling.
And they're afraid of making mistakes. And how do you learn if you don't make mistakes? How does a child learn to walk unless they fall down?
Yeah.
But in school, you get punished for making mistakes. Stupid, 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 you made a mistake. And you sit there, you memorize this answer. A teacher who knows nothing about money tells you to memorize. In 1492, Columbus sailed the
Ocean blue.
You're brainwashed.
Yeah.
And I got I almost had 100 on my test one time. Teacher asked, what was Columbus's flagship? And I asked the question, which voyage? I got hammered for that one.
Wow.
Well, it's because there was 3 voyages.
Yeah.
And the Santa Maria went aground on Hispaniola on the first voyage. But the teacher didn't know that, so she just gave me a 99 instead of 100. I'm not that stupid, but I like history, that's why.
Yeah.
But I asked the question, which voyage? And then I challenged her. I said, well, Columbus never discovered America anyway. He made it to the Caribbean. He didn't make America. Ponce de Leon made it, But most teachers are just robots. They're parrots. They memorize and they give it. They're good people. My whole family's teachers. I love them dearly. I go home to Hawaii, and this was years ago, my aunts would say, oh, they call me Bobby. Bobby, Bobby, have you found a job yet? And I have to go, no, I don't have a job. Oh, we're so sorry. Too bad. Bad luck. I said, yeah, bad luck.
Wow.
It's just a mindset. That's
It's a
all it
mindset.
is. It's a reality.
So now people are leaning in and saying, oh my goodness, I see what he's saying. What should my next moves be? I have some, excess capital, beyond what my means to live with are, and maybe I'm currently spending money on stupid things I don't need. What could my first step be toward trying to create some semblance of financial freedom for myself?
Well, as I said, education is more important than before, but you're going to choose your education.
Mm-hmm. And what educational? So
Well, I wouldn't go back to school personally.
Right.
And people say do what you love. I say invest in what you love. So there's 4 basic asset classes you can invest in. Number 1 is a business, McDonald's. Okay. Number 2 is real estate. Number 3 are paper, stocks, bonds, mutual funds, ETFs, and savings. Number 4, commodities. I don't touch paper at all. I don't have stocks, bonds, mutual funds, or savings because I can't control them. I can control my businesses, I control my real estate, and I control my gold and oil. That's what I do. I'm a control freak. But most people don't have the skill set or the training to control their assets. So when people ask me what should I do, I said, well, what do you love? Oh, I love real estate. So we'll take a real estate course. Oh, it takes money. I go, yeah, I don't have any money. I say, I also have no spiritual intelligence.
And I was just about to say, and that's where, the sense, if you can say out loud, that takes money, I don't have money, it's almost like a negative affirmation.
Yep.
That spiritually now you're poor, not broke, but poor as a mindset.
You're spiritually poor.
Yeah.
Somebody took your heart and soul out of you, your willpower.
Yeah, because the entrepreneur says, hey, if I lost it all today, I wake up tomorrow morning with my mind
make it back.
and my energy, and I can make it back.
Right. Most people don't have the spirit. They're emotional. Their emotions are so over. What if I fail? What if I don't have money? Then your spirit's been ripped out of you.
Yeah.
That's the sad part,
The doubt almost is like a poison, right, to their soul. I mean, it's like this doubt of that. What if these fears?
Don't make mistakes. If you make mistakes, you're stupid. You got to have money. Look, the reason I love real estate is I don't use my money. I use my bank's money. It's called debt. All I have to show the banker is how I'm going to make money with the bank's money. That's all I have to do. And what I said is good debt and bad debt. Most people have bad debt. Bad debt is debt you pay for, like credit card debt, your mortgage, car payments. Good debt is somebody else pays for you. So I have 6,700 apartments. That's 6,700 people paying my mortgage for me. That's heaven.
Kind of interesting thing, yeah. That you
And I pay no taxes. So I took a real estate course when I came back from Vietnam. It cost me $385. That $385 has made me a multimillionaire over and over and over again. Whereas my friends who went and got their MBA, they're still they're afraid of getting fired.
to try to figure out how to pay for their student loan. You mentioned a book by M. Buckminster Fuller that you read that had a massive impact on you. Was there more about him that influenced your thinking?
Well, again, that seems like a parallel universe because in 1967, I was at school in New York. I went to the Merchant Marine Academy. And there was a thing called Expo 67 in Montreal. So my classmate and I hitchhiked to Montreal to see the geodesic dome that Fuller built. And the geodesic dome by Fuller was the U.S. pavilion at the World's Fair. But I never met the guy there. And then years later, in the 81, he put on a seminar called The Future of Business. It was 1 week long. So I traveled from Hawaii to California to attend this 1 week seminar with Dr. Fuller. And he blew my brain away. It went, boom. It transformed me. I saw another world. So I think the spiritual side kicked in versus the mental side. And he had a saying, he says, you do not belong to you. You belong to the universe. Your true purpose may be forever obscure to you, but you may rest assured you're if you commit your life to the highest advantage of others. And so in 81, I had to ask myself, what do I know? What can I do? As Fuller says, I'm just a little guy. Yeah. So what can we all do as little people? And we find our purpose when we want to help others. We don't find our purpose when we just want to make money. And that's what I was doing. So I said, what do I know? And that was 81. Then 83, his book came out, Grunch of Giants. And it was about how the central banks of the world rip us all off. I knew that game.
Wow.
I grew up in it. I know it. So then I said, I'm going to have to start teaching. So my wife and I in 83, God, sad, I sold everything. My wife and I went homeless just to teach. And we just kept teaching what we knew about money. And today we're multimillionaires, just kept going.
So it's interesting that the purpose drove you and
To teach.
and to teach. And
I hated school too.
isn't that amazing?
Yeah.
I mean, the irony in it. But then the outcome as far as long term, I guess it's kind of like we make plans and God laughs. It's like I want to accomplish this by this and this by this time. You just knew what you had to do based on something that moved you in your life. Was it?
I had no idea. Like he says, your true purpose may be forever obscure to you.
Yeah.
So what do I know? And what I knew was entrepreneurship, what my rich dad taught me. And so my wife Kim and I left Hawaii, moved to California, we were homeless, and we just kept teaching. And as Fuller says, always and only in the nick of time, life support showed up. And magic happened. Next person that Kim and I met was John Denver and Bucky Fuller's daughter. And when people say, how is it you spend time with Donald Trump? Why were you on Oprah? Why is all this magic happens to you? Because I'm not doing it for me. I'm doing what I know I think I can do. What can I do? I'm a little guy. If you focus on what you can do for others, God will take care of you. But you have to be smart too.
And you were with your wife, homeless, and money and relationships. There's a big relationship there as far as what happens when there's financial strain in a marriage. Did it bring you closer together? What happened for you in that period of time?
Well, it wasn't easy, let me tell you. So we were homeless for a long period of time, but I already had some basic skills, and then so I was an entrepreneur. I made money teaching and things like this, and I just kept investing in real estate, and we got richer and richer and richer, and I kept teaching, I got richer, and that's what happened. So was it easy? No, it was hell, but it made us stronger, spiritually stronger. So we got stronger as a couple and richer and happier and stuff like that, good stuff. But it's not been easy. No. We had people steal from us, partners rip us off, lawsuits. But you just get stronger. Don't retaliate, just get stronger spiritually.
Don't retaliate, just get stronger.
Yeah, get smarter and stronger.
And this is the thing that I think is very important. Many times people think there's that material wealth and spiritual wealth are on opposite ends of a continuum. If you want to be more spiritually wealthy, you got to move away from material wealth. And if you want to be more material wealthy, you got to move away from spiritual wealth. But what you're proposing is that actually they can and should be one and the same.
Yeah, it depends on you. It's called standard of living. I like my standard of living. But I also write a lot about it. People say live below your means. That's not my philosophy. Like, I've had 4 Ferraris now. Now, do I need 4 Ferraris? No. But every time I want a Ferrari, it's inspiration. So my wife says, so I say to my wife, I want a new Ferrari. She says, you know the process. The process is I got to go find an asset that pays for the Ferrari. So my assets pay for my liabilities. And so every time I did that, I just gained more assets, and I sold the Ferrari. I still had the asset. You know what I'm saying?
Yes.
Is that, like, I wanted this Porsche one time, so I bought a mini storage, nothing down. The mini storage then bought the Porsche. I sold the Porsche. I still had the mini storage. That's mental,
Yeah.
It's just education.
Well, and it's, in a sense, you used this term earlier, it's a model. Like you talk about, it's a
Mindset,
business model. It's just another model of how you like to, utilize liabilities that bring you pleasure.
It's just a challenge, I mean, some people like to run triathlons. I don't. I'm a rugby player. I like, I'm not a soccer player, I'm a rugby player. I like hitting people. Why don't I play soccer? Because I can't hit people. We're all different, that's all I'm saying,
Well, you spent many, many decades, and your own personal story is extraordinary, and you want to see the world a certain way. Like you said, you certainly don't need to be sitting here talking to me right now, but you show up. and there's a reason for all that. Did you ever have sort of a summation on what the impact is you're hoping that your purpose to help other people is? Like, what do you want to see as a legacy?
As I said, as Fuller taught me, he says, you do not belong to you, you belong to the universe. And we're all sent here to do something. We all have a special, unique gift, something that happened to us along the way. And it's like from the Bible, not really religious either, but there was a story of the master who had 3 servants, and he gave each of the 3 servants different talents. Now the switch in there, talents is also money, but talents are also gifts. Mm-hmm. So we're all given certain talents, not the same talents. And there was that one servant who did nothing, he wasted his talents. Another servant buried his talents, and the others multiplied his talents. Mm. That was a way of saying, give your talents. But most people don't do it, they work for money. Yeah. They want money becomes their master. And it's really silly because you don't really need money to get rich. That's why I like real estate. It's my banker's money. And it's my tenant's money pay for my banker's money. And it's a nice world, and I get tax breaks. I'm in the business of McDonald's. Yeah. My business is real estate.
Well, thank you so very much. Really a great honor to be with you and to speak to you.
Thank you. I appreciate it.
Thank you so much.
I have deep admiration and reverence for high horsepower minds. Roger Hamilton is a person who possesses one of those. This man takes concepts, integrates them, and speaks to them in ways like very few people I have ever met. He is an unusual guy with great talent who inspires, who gives content and information that can absolutely change lives. As a matter of fact, that's what he does every day of his life. And this is an interview that you're going to want your pen, paper, at hand, ready to go. You're going to learn a lot. So enjoy this interview with Roger Hamilton. Roger, it's great to see you, and I really appreciate you taking the time to sit with us today. Let's start with your background, your history. How did you get to be doing what you're doing now?
Well, it really started, I would guess, when I was at Cambridge University, where I was studying architecture. And to begin with, I thought my whole life was going to be being an architect and going out and building buildings. And I happened to be inspired by someone called Buckminster Fuller, who had this whole vision of the future of the world, where it was up to us to decide whether or not we're going to actually make that big difference in the world and the future that we wanted to create for ourselves. And being an entrepreneur allows you to be able to actually create the future that you want for yourself. And I went from a switch from building businesses, building buildings to building businesses, and from there creating the future. And I started my first business when I was like 21 years old. I went from one business to another, failing along the way, taking the cynic route, and then eventually figuring out some key principles, which has enabled me to now have a number of companies. We have a listed company called Entrepreneur Resorts, which has got resorts for entrepreneurs in a number of places around the world, like in a safari, on a ski resort. And then we also have a network, which has now got 1.5 million entrepreneurs around the world, which are spread across 200 countries, where we are out really doing everything we can to unite and collectively support the 17 United Nations global goals to really make a difference in the world in all the areas where the world really needs it right now.
Wow, that's amazing. Tell us your economic philosophy.
Well, I think that there's a really interesting concept around, or at least belief around, how wealth is directly related to money. And what I say is actually the opposite, that wealth isn't how much money you have. Wealth is what you're left with if you lose all your money. You know, that there's actually a whole number of things that we could all be doing on a day-by-day basis, which actually is creating wealth for others, creating value for others, which just naturally then has wealth come back to us as well. So there's really like 3 types of capital in the world. There is the one that we tend to see, which is financial capital, where we kind of think it's this fixed thing, which is made of money and properties and businesses. But there's 2 others which are much more important, and they're actually almost invisible. But we see them in those who actually are growing those 2. And it's almost like in an iceberg, where these are the 2 that actually raise up the financial capital. And one of them is our intellectual capital, which is what we know. And every day we can invest our time in the things that we need to know. And the second one is social capital, which is the people we know. And if we actually start really investing every time in and the people that are going to really support us, or the ones that we can support, if every day we're also thinking about our knowledge and how we can grow our knowledge, then, like I said, if you actually were to lose all your money, you still have those two things. And that always allows you to actually be one step ahead. What is so important today is that we are living in a time when there's probably more fear than ever in terms of whether or not we have control on the capital that we have. You have no control on financial capital, right? Markets are going to rise and they're going to fall, but you always have got full control over your own knowledge and your own connections and the trust you can build between those two as well.
That was great. I love that. Tell me in a broad sense, what do entrepreneurs need to know to create success?
When I first decided to be an entrepreneur, there was no manual. In fact, you could actually argue there's still no manual today. There was no manual or any place to go. And especially if you're coming out of like academia, and we all have gone through some kind of education system where we actually realize almost the opposite of what you need to do to be an entrepreneur. So for example, an academic needs to know in order to do, right? You've got to like say, okay, I'm actually really clear on what I need to do before I actually do it. And you wouldn't want to take the exam unless you've studied for it. Whereas an entrepreneur does the opposite. They need to do in order to know, which means that if they don't know how to do something, they don't stop themselves from doing it. They say, well, I better get into action, because all the learning is going to come from the actual action itself, which is really interesting as a concept, because most people are saying, well, I'm not really sure if I can even be an entrepreneur, if I can go out there and find the answers for myself. And so I'll kind of wait until I feel confident enough. And of course, it means you never get started. So the moment you actually see the opposite, which is that an entrepreneur says, okay, I want to actually get going. I'm going to give it a go. I'm going to try something out. And more importantly, they're actually working with others, ideally, that already have had that experience as well. So you're not trying to just figure it out for yourself. I mean, I still remember my first mentor when I was like 21 years old, I was starting my business. And he was like saying, hey, why don't you contact this person here, because they're already doing something similar to what you're doing, but much better. Or why don't you contact this person over here, because they're going to be able to give you advice in this particular area. And I still remember I was like this young know-it-all where I was like, no, I think I'm going to figure it out for myself. And then a couple of months later, he came back and he's like, you haven't contacted any of those people I mentioned, have you? And I go, no. And he says, what are you trying to do? Go out there and create like a original mistake? Like, you think there's a mistake you're going to make that other people haven't made already? And it really is so key when you realize that all the knowledge is already there. Every one of us can go out there and we can actually make a life for ourselves. I think probably one of the biggest misnomers is that for many people, they think they're actually more secure having a job than actually going out there and creating a job. And really, that's the big difference that I see between an employee and an entrepreneur. An employee needs to get a job, which means if there isn't a job there, then you're in trouble. And especially with the amount of technology that's growing, AI, robotics, like the technological unemployment is a real thing, where we are actually training kids today for jobs which aren't going to even be there when they actually graduate. So if you're actually out there like just trying to figure out, do I have the skill set to get a job, that's not going to be enough in the new economy. However, if your skill set is to create a job, which is what an entrepreneur does, then that's a totally different thing, because if you can create a job for yourself, out of nowhere, you can deliver value. Someone sees enough value, they want to pay you money for that. And if you can create a job for yourself, it means you can create a job for others as well, right? And that's really the biggest, for me, the biggest key to what an entrepreneur is that ability to actually be able to pass on your value to others and never be living in lack where you're worried that you're not going to have enough, but always be in a place of abundance where there's always a way to actually create more.
So you mentioned when you were 19 that you had gotten some advice to go out and seek advice from people who knew. Isn't it a common trait amongst entrepreneurs that they know what to do no matter what?
I think one of the myths almost of entrepreneurs is that we think they're these like almighty, fearless, like individuals that are going to go out and risk everything. The reality is actually the opposite, right? If you actually look at the story of someone like a Warren Buffett, who's now one of the wealthiest people in the world, when he started, he didn't start by saying, I'm just going to go out and take lots of risk. He said, well, who could I really learn from? Like, who's a mentor who would be someone that I would love to actually be like? And Benjamin Graham, who was the number one investor in all of America at the time, he was the guy that Warren Buffett went to and said, look, I'll come work for you even for free, right? Just so I can learn from you. When you look at the story of someone like Bill Gates, when Bill Gates didn't start by saying, I'm just going to risk it all and go out there and put lots of money into like PCs. He didn't even have money at the time. He started by saying, well, who there really has a need, right? And IBM had this need for an operating system, and he says, well, okay, if you do a deal with me where you are willing willing to pay me for it, I'll go and I'll deliver for you that operating system. And then he went off to Canada and bought the operating system that became MS-DOS. So in every one of these cases, there's an element of how do you make a commitment towards something, but not at the point where you're making it a crazy commitment or you're risking everything. And that's one of the biggest myths that I see, is that people think they have to risk it all to make it happen, without realizing there's actually some easy, simple steps you can take to actually get started in the first place. I think the biggest thing is getting started. So there are these 3 C's, which are the opposite way around. It's like the whole world has to be turned on its head to use these 3 C's from what we learn at school compared to what happens when we actually become an entrepreneur. And these 3 C's are, first of all, clarity, and then certainty, and then commitment. And what tends to happen for most of us is like, I can't really commit to something yet until I really get like certainty that this is the right thing. And I can't really get to certainty, I've got clarity. So I better go out and just wait for the clarity. And when we go to school, this is exactly what happens. Like, okay, we need a teacher to give us clarity. Like, what's in the textbook? What are the things I need to know? And if I know those things and I revise it enough, then I can get certainty that I actually know this information. And when I've got certainty, then I can commit to the exam. I can say, yes, I can do this exam now. And the problem with entrepreneurship is that commitment can't be the last thing that happens, because you can't get clarity from nowhere. You can't just immediately know how to do something. We all know it's like whether you want to play guitar or whether you want to fly an airplane, right? Anything that has a degree of complexity to it, we know that to actually have any kind of clarity on it requires lots of practice. And with entrepreneurship, it's exactly the same. So what you'll notice about a lot of the top entrepreneurs, the kind of people we hear of today, like Richard Branson, Elon Musk, these are all people who actually started by saying, well, I'm going to start with commitment. I'm going to reverse it around. I'm just going to say I'm 100% committed to making this happen. Like Richard Branson said for a long time, I'm just committed to being that maverick entrepreneur, and now he's committed to going to space. Elon Musk even more so, I'm going to go to Mars. And when he makes that commitment, says that's what I'm going to do, that then leads to the next step, which is say, well, like, how certain am I going to happen? I'm 100% certain it's going to happen. A lot of people think that perseverance is something that you need to have to be an entrepreneur, but perseverance isn't like a quality that you have. It's the result of committing to something and being certain it's going to happen. Because of course, if you're committed to it and you know it's going to happen, and you try something that doesn't work, you don't give up because you still know it's going to happen. You just try something different. That's what perseverance is. So what you see when you see perseverance is someone already saying, I'm certain it's going to happen. I don't know how, I just know it's going to happen. And then continually trying new ways to do it. And eventually the clarity comes from the fact that they actually are on this pathway and they keep on trying different things to get there. And that's why I think it's possible that anyone today, whether they are just coming out of school, whether they've been a job all their life, whether they're 60 years old, can be an entrepreneur today. Because all it takes is that commitment to actually a higher level of lifestyle, a higher level of impact that you want to make, and then knowing that we're living in a world today where every one of us can go out there and make that big difference if we choose.
We make documentary films and documentary series, and often in the film business you have young people who are coming in and trying to make their way in it, and they get knocked down and they have to get up and dust themselves off and keep trying and get knocked down again until they find a crack in the door and they try to go through it. Often tenacity plays a role in success, so can you talk about that a bit?
So just on that point about like trying something out and giving it a go, we are living in a world today where it's easier than ever to actually get that feedback. Take something like filmmaking, right? Like with filmmaking in the past, the only way to even have a shot at filmmaking is that you actually had to be accepted by some kind of studio, because the only way someone was even going to see a film was to go to the cinema, and there was only so much screen time in the cinema, so you had to be one of the top 1% to even be able to be there. Today we have YouTube. Today anyone can be a filmmaker and actually give it a go, and people will immediately say whether they like what you have or not, and if they do like it, they'll share it, and if they share it, other people will then see it. And so we have more filmmakers in the world today that are actually out there giving it a go and actually seeing the result of that. And then the real key thing is, how do you actually go from trying something out and seeing there's value to it to making sure it has monetary value, which means you can actually put money in your pocket as a result of doing that as well. And that's that next step, which is what a lot of entrepreneurs really get challenged by until they realize the whole nature of money in the first place.
You talked about the workshop meditation you do and how it perplexed you. Talk to me about what the workshop is, what it does.
So the way that we support entrepreneurs at the moment through our community. So we have, first of all, a platform which is called Genius U, and Genius U has got every single day about 5,000 new entrepreneurs that are actually joining us. So it's a huge entrepreneur movement that's taking place around the world. There's actually statistics now, the studies that show that the gig economy, is like someone who's got a second job or someone who has got something outside of a full-time employment at work, that the gig economy is actually going to make up over 50% of the entire US workforce within the next 5 years, which is phenomenal. And so because you have so many different people that even if they have a full-time job, they're trying something on the side. So many people are actually already freelancers. Everyone who actually drives an Uber, everyone who's already basically like putting themselves onto Upwork, every one of them is finding simple, easy ways for them to actually generate income. The real key is how do they actually connect with others to really be able to evolve and grow what they're doing. And so Genius U supports all of those entrepreneurs. We have all these people coming on board who then have the ability to learn from each other. We have micro degrees on there. We have events taking place around the world. So this next year, we have over 500 events that entrepreneurs are coming to. And at every one of them, we call them entrepreneur socials because they're for social entrepreneurs. They're for making an impact and a difference in the world. And then we, as a result of people coming and wanting to learn what's the best way to be entrepreneurs, we have our resorts in our safari in South Africa, in Bali, Indonesia, in Europe, we have a ski resort where in each one of these places, we have entrepreneurs who show up and redesign their life and actually create the life they want to live and the impact that they want to have as well. And that's where the real power in everything we do is that it enables everyone out there to have a second education, which is not an education to be an employee, it's an education to be an entrepreneur. And from that, we just hear the most incredible stories of people that start from scratch and are able to then actually go out there and provide not just for themselves, but for the family, for the community, and for the bigger purpose that they have in the world as well.
Is there a follow-up experience that you guys do, like when somebody has a great experience, at a ski resort? What kind of follow-up do you do in the work that you do?
I find what's really interesting is that within the whole entrepreneurial journey, there will be those who get started at the beginning and they're just not even sure exactly which way to go or how they even start their own business. So we have groups in cities all over the world. So for example, here we are right now today in Austin, and we have a group in Austin that actually meets every single month, and it gives everyone a chance to get that support from each other. And then if they want to get connected to people in Mumbai in India or in Tokyo in Japan or someone in Brisbane in Australia, they can immediately connect to one of our other communities, and everyone is then connected to each other and finding all the very best ways to work with each other. And then we actually run larger events where people can come to those events. There's one event called the Global Entrepreneur Summit where we have every single year thousands of people that come to those events and then connect with each other and hear from the top entrepreneurs in the world. And then we also have got the ability for people to actually mentor and train each other, or even to have someone come in and train in their business, because over time it's become more and more clear that there is a pathway or a roadmap to how an entrepreneur becomes successful, regardless of what your interests are or the key things that you actually want to develop for yourself. And that's really because of these three things that actually make up what it takes to be a great entrepreneur.
That's cool, great. Talk about now money management, the 5 lanes and the wealth lane.
So the three things that you actually need to have to be an entrepreneur, goes right back to the Renaissance, where if you actually take education today and say, well, what are the three things that we tend to learn in education? They're really memorization, calculation, literacy. And these are three things that already computers do way better than us. They're going to calculate much more effectively than us. They're going to be able to memorize way, way better than we can forever. Even literacy, you can Google anything and you're going to get the information. So effectively having an education system which is teaching us to be better computers is never going to work. But if you go back to the Renaissance, which was like it's like now within 1500s, 500 years ago, in the Renaissance, the three big things, something called the trivium, were first of all self-awareness. We don't really learn that much about that at school, but as an entrepreneur, it's something you have to have. If you're going to be looking to build your wealth, you have to have self-awareness as who you are. You have to have, secondly, self-mastery. And self-mastery is all about the extent to which you're becoming the better version of yourself. And the third one is self-expression. And self-expression is how you then express yourself in its purest form. Entrepreneurship is self-expression. All the best entrepreneurs in the world, they've actually found a way to express themselves through their business and through the enterprise and the difference they're making in the world. And the biggest challenge is that for many people, they think a job is paid productivity. Like, as long as I'm being productive, then great, it means I'm going to be making money. The problem is that always computers and AI will be more productive than you, cheaper than you, which means you're always going to be out of a job if you think a job is paid productivity. But if you think a job is paid self-expression, which means it's about how you express yourself in the purest form, you're always going to be able to evolve and grow. Even with AI, it will actually help you be a better version of yourself as well. So what we teach and what we've seen so many people go through and the process they go through is, first of all, self-awareness, using tools like in Japan, they have a concept called ikigai. So ikigai is your reason for being, like why you're here on the planet. So anyone who's watching this, they could be there thinking, geez, I just need to do something that's going to make me money, without realizing you can actually make money on anything, but if you're doing on something that's unique to you, you're much more likely to make money than chasing someone else's formula. So the 4 things that make up ikigai is number 1, what you love, which is your passions. Number 2, what the world needs, which is your purpose. Number 3, what you're good at or great at, which is your talents. And number 4, what you can make money at, which is your business model. And what most people haven't really ever assessed is, well, what do I love, and what is my purpose? And what am I talented at? So what's happened over time is that we have evolved within our platform all of these different tools, which means for free, because we have schools using this, we have kids using this, we have teenagers, and then of course like people coming out of work, or someone who's either retired and wants to come and start another business, or even someone starting their own business. They can find out what their passions are by taking the passion test, what their purpose is by taking the purpose test. And we've done these with the top people in the world. So someone like Chris and Janet Elwood, who've written the passion test as a book, it's a best-selling book. We've worked with them to actually put this passion test together. With the United Nations, who have the 17 global goals, we now have got the purpose test, which shows which of those 17 global goals is your number 1 goal. So mine, for example, is quality education. And the great thing is when I take that test and I find that's my answer, I can then connect to all the other people that have taken the test around the world who also have education as their number 1 thing. And then that allows me to then collaborate with them, or for the greater cause of improving education. And so the power in all of this is that at every level, we can actually find out exactly what the steps are that enable us to actually then have that self-awareness and then to grow that as well. I think one of the biggest things that for a lot of people when it comes to money and trying to manage money is that they're actually out there almost chasing the money without realizing that if you let the money get attracted to you by actually being the right person that is working in the right way to be of value to those who have the money, you're much, much more likely to get to success. In the same way that if you go on a football pitch and you go chasing the ball, good luck to you, because like everyone's going to be passing it to other people, especially if you're not part of the team. But the moment you actually join a team and you actually go to where you're needed, you go to where the ball should be, then people start passing it to you all the time. And I think that's one of the biggest challenges for people. They think they need to go chasing without realizing it can all come their way, right? And that's where like we have a system which is called the Wealth Lighthouse, and that's where we have 9 levels. And these 9 levels are levels of consciousness, really, which allow you to actually lift yourself to a high level. And if you get stuck at a level, don't expect the money to ever come, because it's about your own consciousness and awareness of basically how you're delivering value, which is going to either limit the money that comes your way, or it's going to actually enable you to actually step yourself up to the next level, where the money itself will then grow to the next level as well.
When you're talking about the soccer ball, it reminded me of that great quote from Wayne Gretzky. When they asked the key of his success, he said, "I don't skate to where the puck is, I skate to where the puck is going to be." So when we look at technology and how it might cost jobs, or technology will replace jobs, how does this relate to your Lighthouse model?
So one of the big things that for me is the driver for everything that I do really comes from really the person who inspired me to go way beyond just the architecture I was learning at Cambridge, and that was Buckminster Fuller. And Buckminster Fuller, who is himself a futurist, he created the geodesic dome. He was the one who talked about this concept that we're all on a spaceship Earth, and we're all crew on spaceship Earth. He talks about how we're in something right now called the final exam. He said the final exam is this exam on humanity, that we are living at a time where there's this acceleration of technology that's taken place. He said all the world's challenges are all distribution challenges. So for example, when we say there's poverty, we're not saying there isn't enough money. There's plenty of money. It's just not distributed effectively, which is why some people have none of it. Or when we say there's hunger, we're not saying there's not enough food. There's food mountains out there, but we still have people who are in hunger because it's not distributed effectively. So technology allows us to solve all those problems, right? Because technology allows us to be able to distribute more effectively. So why then already are these problems not solved? And he said, even back in the 1980s, he said the reason they're not solved is not because of the technology, it's because of human consciousness. He said that with human consciousness, if we're constantly fighting each other, if we're constantly thinking there's not enough, we're not even going to try and use technology to actually solve all these global problems. And he said this is the final exam, because we're either going to pass the exam, which we'll know we'll pass it because we've accelerated our consciousness enough that we now are able to harness the technology, and we'll know that because we would have solved all these problems. But there's also the alternative, which is that we don't end up accelerating to catch up with the technology. It keeps on accelerating beyond our ability to be able to capture it. It actually ends up destroying us. And that's why this really is now not just another exam, it's the final exam. When I heard that, I was like a teenager when I heard that, and it just brought such shivers up my spine where I'm like, I'm going to be alive at a time when my great-great-great-grandchildren will look back and say this was the moment in time when this guy, Roger Hamilton, our ancestor, could have done something which would have changed the course of destiny. He was in the generation where every one of us could do something when we're aware that actually it's up to us right now. We see, the environmentalists and the crisis that's taking place within the environment. We see, what's happening right now in terms of leadership and the challenges that are happening in equality. We see just all the issues happening around poverty. All of these different things are things that we can actually solve. And the real question is whether or not we're up for actually making it happen. So it all starts with ourselves. Gandhi says, be the change you want to see in the world. And so it starts by saying, well, if we can't raise our own consciousness up, how on earth are we going to actually raise the consciousness of others up as well? We're seeing today that the people who are the most vocal about really making a difference in the world, they're not the politicians, they're not the large corporations, they're not even necessarily even the charities. They're the top entrepreneurs in the world. The people like Bill Gates, who already has made his money, is spending all his time right now on the Gates Foundation. Jack Ma from Alibaba has actually retired from Alibaba in order to support the entire revolution happening in education. And all the people, the younger entrepreneurs, people like Elon Musk, are spending all their time talking about how we can actually go about there and save the environment by how we can be using electric cars, using solar panels. And all of this is about the fact that every one of us has got the ability not just to talk about making a difference, but actually to make it as well.
Wow, inspiring, especially in this day and age. Let's talk about the I Ching model, personalities.
So when you look at the idea that we have different levels of consciousness, let me just take you very briefly through what the levels are and how they work and how all of this links to ancient models that already exist. So the Lighthouse model has been around now for, I would say, maybe 5-6 years. We've had somewhere in the region of about 500,000 people who've actually gone through this model. And this is also linked to a second model, which is called Wealth Dynamics, which I created about 12 years ago. And that program has already been now used by about 1 million entrepreneurs around the world. So what are these two and how do they work together? Well, first of all, just think for a moment about a lighthouse, the fact that you need to go through different levels to get up to the top of the lighthouse. And think of that lighthouse being what Carl Jung calls collective unconscious, that each of us have got a little voice in our head. And that voice in our head is determining whether or not we decide to be an entrepreneur, whether or not we go and build our wealth, whether or not we complain about things. Like that little voice is doing all this work. And think about that little voice a little bit like if you were a pilot on a plane and the pilot's flying around and he has no idea where this voice is coming from, but there's a voice in the cockpit which is saying go up to 40,000 feet, turn 5 degrees north-northwest. And so he's doing all these different things. And then at some point he's like, wait, hang on a minute. Where's this voice coming from? Like, there's a voice in my cockpit. And so he starts deciding that he's going to go look for this voice. And he goes looking for this little man. And he's like, where's this guy? And there's no one there. And he's like, this is a bit strange, right? And like, where's that voice coming from? So he decides to call a friend. So he calls another pilot who's a bit more self-aware. And he says, do you have a voice in your cockpit? And the pilot goes, yeah, sure I do. Yeah. He's like telling me where to go. And he goes, yeah, well, where is he? Like where is this guy? He goes, no, he's not in the cockpit. He's out somewhere else. Like where? He's in the control tower. In the control tower? Yeah, there's a control tower. And that's where the voice is coming from. Wow, well, is that where my guy is as well? He goes, well, not only is your guy also there, your guy is the same as my guy. It's the same guy. It's like, what do you mean it's the same guy? It's like, is it not my voice? It's not only your voice. It's the same guy that's my voice. A lot of, like Carl Jung, when he talks about collective unconscious, he's like saying that the voice that's in your mind is actually the same voice that others are getting in the same mind as well. And that's what the lighthouse is all about. It's like the control tower. And in this control tower, depending on where we're at, we're hearing a different voice. So most of us in our lives have had some time in our life when everything was just going great and fabulous. And no matter what we did, nothing went wrong. And at that time, like the little voice is invincible. It's like saying you can do so many amazing things. But at other times, we've had like a life where nothing works, where everything's going wrong. And at that time, you've got a voice saying you're a failure, right? Like nothing's working. But if you actually realize you can actually switch that voice you can tune into a different radio station because it's all out there already. And your greater self is out there as well. What happens within The Lighthouse is that we break it into different prisms, and someone can go and just take the test. It's a free test, and it shows you which of these levels you're at. And for some people, they're trying to build the business, but they're in one of the first 3 levels, which is what we call the foundation prism. And the foundation prism has nothing to do with the flow in your business or in your investments. It has everything to do with the flow in your own personal life. So this is called the foundation prism because it's about personal flow. And the base level, infrared level, which is in the basement, is what we call the victim, and it's someone who, no matter what else is happening, every single month, without fail, they go more and more in debt. So if any viewers watching this and they're like, that's me, right? And I have lots of people who come to me saying, help me with my business, but I'm looking at their personal finances and they're going negative. I'm saying, if you can't take $1 and make more than $1 from that yourself personally, how on earth can you do that in the business? Your business is always going to be a reflection of yourself. So the moment they change themselves and they start valuing themselves and they start paying themselves more, suddenly the business also takes care of itself as well. So that first basic level, infrared level, then leads to the second level, which is red level, which actually is more dangerous than infrared, because red level is where you now are making just enough money to have nothing. So this is where you can go like the bottom line, it's not sustainable if you keep on going more in debt. At some point, you're going to go bankrupt or you're going to have to refinance. But at the next level up, you can be there forever. And there's a huge, like massive Americans, in fact, not just America, in Europe and other Western developing countries that are at red level, which means they go their whole life, no matter what they're doing, no matter how hard they turn the tap on and make more money, it all just disappears again, right? And if you haven't yet learned how to turn your time into more money, there's no way you can figure out how to turn your money into more money, because this is all about your value, how much you value. But if you actually figure this second one out and you go, oh, you know what? I don't want to be at this stage. I actually want to know that I'm a positive contribution to the planet. And you go to this third level is orange level. This is where you now are called the worker, which is where you actually earn the right to actually even start a business. So in the same way that a lot of people say, I don't need to learn how to swim. I just want to get on a boat and go across the ocean. So I don't need to swim to do that, without realizing no captain will ever take someone onto their crew who doesn't know how to swim. So you need to earn the right to get into the crew before you get into the crew. So if you get to that third level, which is orange level, where you have positive cash flow, you've now bought your time. You're in a position where you actually know how to turn money into more money. And there's actually some very simple steps you can take to make that happen. The good news is some people might have been in one of these first 3, for like decades, if not their whole life. And then the moment they get this, they can switch out of it within months, if not weeks. And the moment that changes, suddenly their whole business turns around and investments come their way and attraction comes their way as well. And I've just seen this again and again for everyone who decides, right, I'm going to actually focus on myself and improving where I'm at. Now, if you do that and you can go to the next level up, the next 3 are called the enterprise prism. And the enterprise prism are all about the flow of the markets. So the money will always flow in the markets to these next 3. They will never flow to the ones at the bottom. In fact, if anything, the ones at the bottom are like the rocks in the river, like the flow's flowing around you and you're wondering where the money is. But the moment you lift yourself to a higher level, but above worker is the opposite of that, which is the player. The player is the yellow level. And if you think about these like chakras, the first person to really bring chakras to the West was Isaac Newton. And Isaac Newton has a book which is called Optics, which he wrote before Principia, which was where we know him for Newton's laws. And he was the first person to take white light and turn it into the rainbow using prisms. And he wrote about that in Optics, and he decided to actually decode the rainbow as the colors of the chakras, because he knew all about the chakras and about how they're levels of consciousness. And the reason we have these 9 levels is below the red of the rainbow is infrared, and above the violet of the rainbow is ultraviolet. So we've got the whole electromagnetic spectrum within this. And so when he actually went through these, he was very aware of what these different levels are. So when you're at yellow level, this is Stephen Covey talks about dependence, which is at the foundation level, where you're depending on others for money. At yellow level is independence, which is you can now make the money yourself. And then green level is interdependence, which is where you're actually not asking, how do I make money? You're asking, how do I help other people make money? And it lifts to the next level as well. And that's heart chakra. So if you're a yellow level, this is where you've got like the player is like playing the guitar. Great, you've got a solopreneur, you figured out how to make some money. The problem is that if you were to actually stop playing the guitar, the music stops. So people who are in that situation, they're like, geez, I've got to keep on showing up for my business every day. The next step up from that is going from, okay, yellow level is where I'm the one saying, how do I make it happen, to green level, which is how I help other people make it happen. And that's where you now have got what we call a performer, which is a high-performing team. And that allows you to then actually free yourself up from the business, and the business is now working on its own. And then the next step above that, which is blue level, people think that's called multiple streams of income, but it's not. It's multiple teams of income. This is the conductor, where the conductor makes all the music. It's the investor, but he only makes the music because he's attracted so many performers who want to play for him in his orchestra. So when I look at all of the streams that I have, every one of them has got a team that looks after that stream. And so they've been attracted to me because of what we can actually achieve together. And this is where all the flow of the markets takes place within these three. And so if you actually really see, wow, at every level you're stuck until you move to the next level up. If you really get that, you say, then I'm going to work on myself to move to that next level. Above those three, we have the final three, which is called the alchemy prism. And that's where you can change the world. And so the likes of the top entrepreneurs already, they've gone up to indigo level. That's the trustee, someone like Richard Branson. He can make millions of dollars as a trustee by people just saying, I'll pay you millions to have a version company. So trust is now so high that people are actually willing to now come on board and actually then use part of that trust as well for themselves. And most of them are a trustee of a particular movement or a particular way of doing business. Someone like Warren Buffett's a trustee. People will pay him millions just to have lunch with him. One level above that then is now the violet level, which is a composer who's the person who makes all the music. All of the broken compositions in the world today are why we have the challenges. Poverty is just a broken composition, because there's a way for us to create a new composition which doesn't require poverty. The problem we have today is that the people that we put in the place of being the composers, they tend to be yellow level politicians who are very good at getting elected, but it doesn't mean they understand the complexities of the markets or how we go about designing the taxes and designing the money system in a way that works for everybody. And so because of that, it's actually now entrepreneurs saying, well, I think there's a better way to do this. We have people going out creating cryptocurrencies today. We have people going out creating entirely new communities that are actually working in very different ways from the past. And that's what it is to be a composer at that high level. And people like Bill Gates and people like Jeff Bezos are now thinking in that way. How do we actually change the way society itself is working? And then the final one is legend. And legend is now the Steve Jobs, it's the Nelson Mandelas. It's where you're actually a legend on the map, a symbol on the map, where basically now you're going to leave a legacy way beyond your own lifetime. We can all get up to legend level. The challenge is too many people want to leapfrog their way to the top. And that's like the trampoline way to success. You jump up, you come back down, you jump up, you come back down, rather than actually realize we can take the ladder. And if we just took it one step at a time, we can all get to that point where we can make a lasting difference in the world as well. This lighthouse is one that when someone takes it and you realize where you're at in it, you very, very quickly realize what the steps are to take you to another level. And we never learned this at school. It's not something which is there even in a day-to-day looking at the media or in books that are out there. But this is exactly the same system that was used by our ancestors over many, many years and that we can actually use today to really navigate through the big waves that are coming to us from the future.
Well, that's certainly a lot to think about. Is there anything new that has your attention?
If someone says, well, where do I start with all of this? If I just want to make sure that I'm actually in a place where I'm ready to go out there and invest, to actually use all these different tools, the biggest challenge is for a lot of people, the way they treat money is already where the challenge begins. So for example, if I was to go to someone who was maybe a chef or a cook who was going to cook a meal, and I was to give them all the ingredients that they needed and even the recipe, if that person went out to get all those ingredients and brought them back to the kitchen, put out the recipe, but then took all of the ingredients and put them in a big bucket, like the dessert, like the soup, like the main course, and it was all down in this big bucket, and then looked at the recipe and then tried to pull all the food back out of the bucket to then make the meal's already ruined. The number of people who try and manage their money with just one bank account, which is just like one big bucket, and they put it all in there, and then they're trying to then create some masterpiece of wealth, and they're wondering why they can't do it. It's because they themselves have already messed up the ingredients before they got started. Now, the good news today is that there's some really super simple ways that it's possible for you to actually already create the flow that enables you to be able to now expand and grow your wealth and use all the amazing tools that are coming out of this whole documentary and this whole series that enables you to actually then use them. And how does it work? Well, very simple. If you actually were to start by going to your bank manager, saying to your bank manager, I need to set up a number of different bank accounts. Tell the bank manager there's a lot of money coming your way, right? Which is true. You're going to be making a lot of money. They're going to do this for free. It doesn't cost you anything. And you say, right, the first thing that I need is that I need to have a clearing account. My clearing account is where I'm going to put the money that I get every single month into this clearing account, and then it's automatically going to go to all the places it needs to go to. And that clearing account, let's imagine you're earning $5,000, right? Well, that $5,000 goes in here, and as you start earning money from a second job or you start earning money from your wealth creation, your new business, it also goes in here as well, and your goal is to increase that on a monthly basis. So if you have that, first of all, the clearing account, why would you do that? Well, because if you were to use that clearing account for all of your payments, for going to the ATM, before you know it, all the money disappears. But if that clearing account has got a second account, which is called your checking account, and your checking account is where you say, hey, the things that I know I need to pay, I got to pay my rent, I got to pay for the car, I got to pay these bills, it just automatically just goes out, and you can just set it up to go out. You always cover those bills, not a problem. When that happens, then you set up a third account, which is your cash account, and that's where you actually put a certain amount and no more, which is going to be what you can actually get from the ATM. And once it's gone, it's gone. And we all know what it feels like when the money's gone. It's like, right, I'm going to budget better when that happens. Because most of us don't do these first three accounts, what almost always happens is whatever money goes in disappears. And if we end up making double as much money, guess what? That disappears as well. But this way, it doesn't. It means that you're actually already in a place where everything is now organized so that it's like a lane into the highway, and then it's basically 2 lanes out of the highway. The problem is this: for most people, when they get the extra $10 or the extra $100, it disappears out the highway instead of it going into the middle lane. So the next thing that you create is your wealth account. Your wealth account now is like a savings account, but it's not where the savings are going to be just like stuck there. It's where they're going to go somewhere. And what you do is every time you bring an extra $100, for example, you say, right, that money is going to go into the middle lane. It's going to go into my investment account. And you're going to see very quickly by just doing this very simple thing that month after month, you went from 100 to 200. Now you got 500. Now you got 1,000. And as that's going into the middle lane, the objective is to get it to the outside lane. And the whole wealth building that you do doesn't happen by what goes into your first account. It's what happens, what goes into your wealth account. And if you then said, right, I've got $1,000 to now invest, what can I do to put it into the third lane, which is your assets? Maybe I'll put that into some shares in the stock market of shares that I want to be investing in. Maybe I'll put that into some investments that I heard about during this docuseries. Maybe I'll put that into the first step towards, some cryptocurrency or, a deposit on my house. But as you actually go to that third step, the whole key is my money turning to more money? If I have 10,000 in there, am I getting 100 back? Am I getting 1,000 back? And if I am, don't just put it back into your clearing account. Put it basically back in your wealth account, right? And then from there, reinvest it again. And as you start doing this, I have seen so many people go from a place where they say, I can never create any wealth, to suddenly, just because they've got lanes in the highway, the whole thing now just growing, just like a beautiful garden where everything now is flourishing. And when that happens, you get to a financial freedom much, 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 much faster by using all the same tools that we've been talking about here, but doing it in a way where it's organized and where it's automatic. And this first key step is what most people miss, which, like I said earlier, is like putting everything in a big bucket and wondering why you can't then sort it out afterwards.
So the meal is ruined, right?
Yeah, exactly.
One final thing, is there anything new that's exciting you these days?
I think that one of the most amazing things that are taking place in the world at the moment is that we are going through a revolution in how people are thinking about their own lives. I think that we have gone through a period of time over the last 20 years, because now here we are stepping into 2020. And I remember this amazing optimism when we're getting to the new millennium, where we're like, wow, we're in like year 2000. That was 20 years ago. And we've gone through a whole period of time where there has been a huge loss of hope, a huge loss of trust. A lot of people who are thinking, well, I can't just rely on the government or on large organizations or on the media or anyone else to look after me anymore, or even tell me what's the truth anymore. And so because there's been this big breakdown in trust has had to be rebuilt in a new way. I really believe there's a trust revolution that's taking place right now. And the trust revolution comes by realizing that trust has got 3 elements to it. It has internal trust. So if you think about it like a triangle, internal trust is called confidence. And we had a massive crisis of confidence with many people over the last 10, 15 years, which is now coming back in new ways. I think there are a lot of entrepreneurs that are really building confidence with their communities. There are a lot of kids at school that are actually finding new confidence through the programs that they're actually joining and through the people that they're now working with, right? Faith-based communities have got confidence that are now growing as well. And from that confidence, you then have got the second thing, which is super important, which is external trust, which is credibility. Is that we're now saying, well, what is most credible? There is a trust index, which is called an Edelman's Trust Index, which shows that there are certain things like the government itself, which is very low in the trust of millennials. But there's other things that are actually very high, including small business, which actually millennials actually do trust, along with things like the special forces, like people who like the police, that actually we do trust more. But the most important thing about this is when we actually realize that the third type of trust, which is the one which actually comes up above the iceberg, is all about future trust, which is predictability, which is people saying, well, I can't predict the future without creating it for myself. So what is this future I want to create? So we're seeing an education revolution taking place right now. We're seeing personalized health and wellness taking place. We're seeing these new movements of equality, of people coming together and deciding to make a difference with the environment. So I'm very optimistic about the next 10, 20 years. By the way, the Japanese have a concept which is called Society 5.0, which actually explains this whole concept. And what they say is that they say that every single massive disruption in the way we do things, in the way we're doing things, actually changes the way we're being. And so the very first one, which was 1.0, was the hunter-gatherer society, where they said, just because we actually figured out how to actually use weapons to actually get our food, we all started actually, showing up in tribes. And that was a whole social structure which we never had before. Then 2.0 was when we actually learned about farming, and we realized we don't have to be in a tribe, we can be in a village. And we actually started villages all over the world start up. And then the third step was the Industrial Revolution. 3.0 was when we said, hey, we're even better in cities where we can actually have lots of people together and we can have factories. And then that all then broke down with 4.0, which is the information revolution, where we realized we could be anywhere in the world and we can get connected with each other. That's when we started creating a global culture, but with that came all sorts of challenges as well. And now 5.0 is when we realize, look, we've got this connected global community that is actually connected to the heart, not just to the technology, that we actually are in a place where we can actually now collaborate and work with each other. And so Entrepreneur 5.0 is not about the industrial revolution or the information revolution, it's about the impact revolution, that we all can go out there and make that big difference today. And in fact, if anything, someone who's there thinking, well, should I not? It's really not a matter of this being an opportunity, which is a maybe. It really is an obligation. It's turned into a must. Because if we don't go out there and make that difference, then the kind of world we're going to be living in 20, 30, 40 years' time, the legacy we leave, it's not going to be the legacy we want to leave. We're going to leave a legacy one way or the other. It's just whether or not we leave one which is accidental, which is the one that we didn't want to have, or is deliberate, which is the one we actually designed to make sure that we're leaving this place a better place for our children and the next generation.
Roger, I just love the way that your brilliance shines and how you can bring concepts to life and put them on the ground and make them very valuable for people. So thank you so much for coming here and sharing all this.
Thank you very much.
To see the next episode in the Money Revealed series, check the video right there next to me. I think you'll love it. Continue to believe, and I'll see you there.
There are a lot of big events that we can now think through, like chess moves. You can make fortunes in the coming years while a lot of people are suffering.